Are you ready to take control of your financial future and build real wealth that lasts? The intelligent investor is not just about money, it's about developing habits, making smart choices, and creating a life where your decisions work for you instead of against you. In this guide, you'll learn how to stay disciplined, protect your investments, and make decisions based on facts rather than emotions. You'll discover how patience, consistency, and knowledge can turn small daily actions into long-term financial security. Imagine waking up each day confident that your money is growing safely and your future is protected. This isn't about luck or shortcuts. It's about learning the principles that successful investors use and applying them in your own life. By the end of this video, you'll understand how to make smarter choices, avoid common mistakes, and take steady steps toward lasting financial freedom. Stay with me because the insights you're about to learn could completely change the way you think about money, risk, and your future. Chapter 1. Build strong financial discipline through consistent daily decisions. Financial discipline is the foundation of every intelligent investor's life. Without discipline, even the most brilliant investment strategies fall apart, and without consistency, even the most inspiring goals fade away. Building financial discipline is not about a single big decision or a grand plan, but about the daily choices you make. It is in those ordinary moments, choosing how to spend, how to save, how to respond to temptation, that your future is shaped. Every decision adds up, and every choice strengthens or weakens your financial life. The person you will become tomorrow is being built today in how you manage what is in your hands right now. The truth is, most people do not fail because they lack opportunities. They fail because they lack discipline. They overspend when they should save. They follow impulses instead of principles. They chase quick pleasures while ignoring long-term peace of mind. This is where the difference lies between those who achieve freedom and those who live in constant worry. The disciplined investor does not rely on chance. He builds a system of habits that protect him, habits that become second nature. And it all begins with consistent daily decisions. Think about how many times in a single day you make financial choices. It could be buying a coffee, deciding whether to cook at home or eat outside, choosing between saving or spending, resisting a purchase you do not need, or selecting a cheaper alternative. These decisions might feel small, but over years they decide whether you build wealth or debt. Small leaks sink big ships, and small wastes destroy big opportunities. The disciplined investor knows this and trains himself to pay attention not only to big investments, but also to little expenses. Discipline starts with awareness. If you do not know where your money is going, you cannot control it. Too many people spend without thinking. They swipe cards, subscribe to things they do not use, buy items they do not need, and then wonder why they are always short of money. The first step toward discipline is tracking every expense. When you see clearly where your money flows, you gain power over it. Awareness is like turning on a light in a dark room. You suddenly see what is really happening, and once you see, you can act. After awareness comes intention. Every dollar you spend must have a purpose. If you spend without purpose, you will regret it later. But if you align your spending with your values and goals, each decision strengthens your future. For example, instead of spending money on temporary pleasures, you can choose to save for security, invest for growth, or spend on something that truly improves your life. Purposeful spending does not mean denying yourself everything. It means deciding carefully and asking, does this decision bring me closer to or further from financial freedom? That simple question can transform your life. Discipline also requires self-control. This is where most people struggle. It is easy to know what is right, but harder to do it. Temptation is everywhere. Discounts, advertisements, new gadgets, entertainment. Businesses spend billions to make you spend without thinking. If you do not train your self-control, you will always fall victim. Self-control is like a muscle. The more you use it, the stronger it becomes. Start with small challenges. Say no to unnecessary purchases. Wait before buying or choose the cheaper option. Each time you resist, you grow stronger. Over time, this habit becomes part of you, and financial temptations lose their power. Consistency is what makes discipline powerful. Anyone can make good choices for a week, but real success comes when you make them for years. The intelligent investor builds habits that remove the need for constant willpower. For example, instead of deciding each month whether to save, automate your savings. Instead of hoping you will resist overspending, set clear budgets and stick to them. Create systems that support your goals, because systems are stronger than emotions. When you rely only on motivation, you will fail. But when you have systems in place, discipline becomes natural. One practical way to strengthen daily financial discipline is to practice delayed gratification. This means you do not give in to every desire immediately. If you see something you want, wait before buying. Give yourself a day, a week, or even a month. Most of the time, you will realize you do not need it. By waiting, you train your mind to value long-term security over short-term satisfaction. This single practice can save you thousands and build your wealth steadily. Another essential practice is budgeting. A budget is not a prison, it is freedom. Without a budget, your money controls you. With a budget, you control your money. Create a plan for your income. Decide how much will go to essentials, how much to savings, how much to investments, and how much to enjoyment. Stick to it consistently. This gives you clarity, reduces stress, and ensures you always move closer to your goals. A disciplined investor does not fear budgets. He embraces them as tools of freedom. The intelligent investor also understands the importance of small wins. You do not have to make massive changes overnight. Start small, save a little every day, cut one unnecessary expense, or invest modestly but consistently. Over time, these small wins add up to enormous results. The power of discipline is not in big leaps, but in steady steps. Every disciplined decision builds momentum. Every victory, no matter how small, strengthens your confidence. One of the greatest obstacles to financial discipline is comparison. Many people lose discipline because they compare themselves to others. They see others buying new cars, expensive clothes, or luxury items, and they feel pressure to do the same. But comparison is a trap. The intelligent investor understands that success is personal. It does not matter what others are buying or showing off. What matters is your own long-term peace, freedom, and security. Discipline means having the courage to live according to your own values, not society's pressures. Another challenge is emotional decision-making. Fear, greed, impatience. These emotions can destroy years of effort in a moment. The disciplined investor learns to control emotions. When markets rise, he does not get greedy. When markets fall, he does not panic. He follows principles, not emotions. This applies not only to investments, but also to daily choices. For example, retail therapy. Buying things just to feel better might bring short comfort, but causes long-term regret. Discipline means pausing, thinking, and choosing wisely, even when emotions push you in another direction. To strengthen your discipline, you must also build resilience. There will be setbacks. You might overspend sometimes, make mistakes, or lose money in an investment. The undisciplined person gives up. The disciplined investor learns, adjusts, and continues. Resilience is what keeps you consistent over the long journey. Every mistake can teach you something valuable if you are willing to learn. Instead of seeing setbacks as failures, see them as training for greater wisdom. Discipline is not only about controlling spending, but also about aligning your entire lifestyle with your values. For example, if your goal is financial freedom, then every aspect of your life, your habits, your relationships, your priorities must support that goal. If you constantly surround yourself with people who spend carelessly, you will be tempted to do the same. But if you surround yourself with disciplined, focused individuals, their habits will inspire you. Discipline grows stronger in the right environment. Building financial discipline also requires clarity of vision. If you do not have a clear picture of what you want, discipline feels like sacrifice. But when you have a clear goal, freedom, security, independence, discipline becomes purpose. Every time you choose wisely, you remind yourself of what you are building. You are not just saving money, you are building peace of mind. You are not just saying no to a purchase, you are saying yes to freedom. Clarity turns discipline into motivation. Daily routines also play a major role. The disciplined investor does not rely on willpower alone. He builds habits into his routine. For example, reviewing expenses at the end of each day, planning weekly budgets, or reading financial lessons every morning. These routines keep you consistent and prevent you from drifting. Success is not built in bursts of effort, but in steady, daily commitment. The more automatic your routines become, the less effort discipline requires. One of the most practical disciplines is keeping a financial journal. Write down your spending, your thoughts, your progress, and your struggles. This creates accountability and self-awareness. It allows you to see patterns, recognize mistakes, and celebrate improvements. Journaling transforms discipline from a vague idea into a measurable reality. When you see your growth in writing, your motivation strengthens. Another key practice is learning to separate needs from wants. Many people confuse the two, and this confusion destroys discipline. A need is essential for living: food, shelter, healthcare. A want is something nice to have, but not necessary. The disciplined investor always meets needs first and treats wants carefully. He enjoys life, but never sacrifices security for temporary pleasure. Learning this distinction is one of the most powerful tools for building financial discipline. Over time, as you practice these daily disciplines, something remarkable happens. You begin to feel a sense of inner strength. You no longer feel controlled by money or by impulses. Instead, you feel in control. Every day you make disciplined decisions. You are building not just wealth, but character. Financial discipline teaches patience, self-control, awareness, and resilience, qualities that improve every area of life. The disciplined investor knows that success is not luck. It is the natural result of consistent daily decisions made with clarity and strength. It is not about perfection. You do not have to be flawless. You only need to be consistent. Even if you stumble, get back up and keep moving. Each disciplined choice is a step toward freedom. Each consistent action is a building block for your future. When you look back years from now, you will not remember the temporary pleasures you denied yourself, but you will feel deep gratitude for the freedom, security, and peace you built. Discipline is not about punishment. It is about choosing a higher reward. It is about saying yes to your best future by saying no to what does not serve it today. So build strong financial discipline through consistent daily decisions. Choose awareness over ignorance, intention over impulse, patience over impatience, and principles over emotions. Track every choice, learn from every mistake, and stay true to your vision. With each day, you grow stronger. With each choice, you move closer to freedom. This is the path of the intelligent investor, and it begins not tomorrow, not someday, but today, right now, with the next decision you make. Chapter 2. Develop clear long-term goals for financial growth. Developing clear long-term goals for financial growth is not simply about imagining a comfortable future. It is about designing a roadmap that guides every choice you make with money. Without long-term goals, financial decisions remain scattered and inconsistent, often leading to wasted effort and unnecessary stress. When you take the time to define what you want your future to look like, you create clarity. That clarity becomes the anchor that holds you steady in times of uncertainty and the compass that points you in the right direction. The starting point is to ask yourself what financial growth truly means in your life. For some, it is the ability to retire without worry. For others, it is the chance to provide opportunities for their children, build a business, travel, or simply live without debt. No matter what the vision is, it must be defined with precision. A vague idea such as "I want to be wealthy" does not provide direction. A clear goal such as "I want to build a retirement fund of a specific amount within 20 years" gives you a target to work toward. The difference between vague hopes and specific goals is the difference between wandering aimlessly and walking with purpose. Once you identify your vision, the next step is to translate it into measurable targets. Numbers bring clarity. If your dream is to retire securely, calculate how much you will need to live comfortably. If you want to grow a business, set a specific revenue target within a certain period. If you wish to clear debt, write down the exact amount and the timeline to eliminate it. Measurable goals turn abstract dreams into concrete commitments. When you can measure progress, you stay motivated and accountable. Equally important is setting a realistic timeline. Financial growth is a process that requires patience and consistency. Short timelines often create pressure and disappointment, while excessively long ones may encourage procrastination. The intelligent investor strikes a balance. If the goal is to save a certain amount, break it into milestones, what you will achieve in 1 year, in 5 years, and in 10 years. These smaller checkpoints help you stay on track and allow you to adjust if life changes along the way. Defining long-term goals also requires understanding your personal priorities. Not every financial goal has the same weight. Some may be essential, like building an emergency fund, while others may be desirable, like purchasing a luxury item. When you clarify which goals matter most, you know where to direct your energy and resources. This prevents the frustration of chasing everything at once. Prioritization is a discipline that ensures your most important goals are never sacrificed for less meaningful desires. Clarity also demands that you connect your goals to deeper values. Money alone is not the ultimate aim. It is the life it allows you to live. Ask yourself why each goal matters. Do you want financial independence so you can have freedom over your time? Do you want to grow wealth to support your family? Do you want to invest in education to expand your opportunities? When your goals align with your values, you are more likely to stay committed even when challenges appear. Goals without meaning fade quickly, but goals with purpose endure. An essential part of building long-term goals is breaking them into actionable steps. A goal without a plan is just a wish. If your target is to save a large sum over 20 years, identify how much you need to save each month. If your goal is to grow investments, decide how often you will review and adjust your portfolio. If your aim is to clear debt, outline the exact repayment strategy you will use. Action steps give life to your vision. They make long-term goals achievable through small daily choices. It is also important to regularly review and refine your goals. Life is dynamic, and so is your financial journey. Circumstances change, Opportunities arise, and priorities evolve. A goal set 10 years ago may no longer reflect your reality today. The disciplined investor does not cling blindly to outdated plans, but reviews them thoughtfully and adapts when necessary. Reviewing your goals keeps them relevant and ensures that your efforts always serve your current vision. One practical strategy for long-term financial growth is to divide your goals into categories. Short-term goals might include building an emergency fund or paying off credit card debt. Medium-term goals might involve saving for a down payment on a house or funding education. Long-term goals could include retirement planning or building generational wealth. By dividing them into categories, you can balance your resources and avoid neglecting important areas of your financial life. Another powerful practice is visualization. When you picture your future clearly, imagine yourself debt-free, living in security or enjoying freedom. You strengthen your commitment. Visualization transforms a distant possibility into an emotional reality you can feel today. This emotional connection increases discipline and motivates you to continue even when sacrifices feel difficult. The stronger the picture in your mind, the easier it is to stay consistent in your actions. Financial goals also require protection from distractions. It is easy to lose focus when new opportunities or temptations appear. Without a clear commitment, you may abandon your plan for short-term excitement. That is why writing down your goals, reviewing them regularly, and reminding yourself of the long-term vision is vital. A written goal is a constant reminder that your choices today must serve the future you are building. Discipline plays a major role in pursuing long-term goals. Even with the best plan, without consistency, progress will stall. The strength of a goal lies not in its size, but in your ability to stay loyal to it day after day. This is why small, repeated actions are more powerful than occasional big efforts. A steady contribution to savings, a consistent review of investments, a regular habit of budgeting, these are the bricks that build the structure of long-term success. Accountability can also strengthen your commitment. Share your goals with someone you trust, or keep track of your progress through a system that holds you responsible. When you know that your progress is being measured, you are more likely to follow through. Accountability creates external reinforcement for your internal discipline. To maintain motivation, celebrate milestones along the way. Long-term goals can feel overwhelming if you only focus on the final outcome. By recognizing each achievement, whether it is saving your first $1,000, clearing a portion of debt, or hitting an investment target, you build confidence and momentum. These celebrations remind you that progress is being made and that every step counts. Finally, developing long-term financial goals requires patience and resilience. Growth rarely happens in a straight line. There will be setbacks, unexpected expenses, and moments when progress feels slow. The disciplined investor accepts these challenges as part of the journey and does not abandon the plan. Resilience allows you to adjust, recover, and continue without losing sight of the bigger picture. When you take the time to define your long-term goals, measure them clearly, align them with your values, and break them into actionable steps, you transform your financial journey. You no longer drift from one decision to another, without direction. Instead, every choice becomes intentional. Every action builds towards something meaningful, and every sacrifice serves a greater purpose. This is how real growth happens, not by chance, not by vague wishes, but by clear vision and consistent commitment. The intelligent investor does not live only for today, but builds steadily for tomorrow. By developing clear long-term goals, you give structure to your efforts, strength to your discipline, and meaning to your sacrifices. You create a future that reflects not only financial success, but also personal fulfillment. Every day you act with your goals in mind, you move closer to the life you want to live. That is the power of clarity, and it begins with the decision to define your path and stay true to it. Chapter 3. Protect investments by avoiding emotional decision-making always. Protecting your investments requires more than knowledge of markets or an understanding of financial instruments. It requires mastery over your own emotions. Many investors lose not because they lack intelligence, but because they allow fear, greed, or impatience to guide their choices. Emotional decision-making is one of the greatest threats to financial stability. The intelligent investor recognizes that markets will always rise and fall, news will always create noise, and uncertainty will always exist. What determines success is the ability to remain steady, rational, and consistent regardless of external pressures. Emotions are powerful forces. Fear can make you sell too quickly. Greed can push you to take unnecessary risks. Excitement can make you chase opportunities you do not understand. Anxiety can paralyze you into doing nothing when action is required. All these responses are natural, but if you allow them to dominate your decision-making, they will destroy years of progress in a single moment. Protecting investments means learning how to observe emotions without surrendering to them. The first step is awareness. Before you act on a decision, pause and ask yourself if emotion is driving you. Are you selling because the market dropped and panic spread, or because your long-term strategy requires a change? Are you buying because everyone else is rushing into an opportunity, or because you have researched and found real value? By asking these questions, you create a space between stimulus and response. That space allows reason to take the lead rather than impulse. Another way to avoid emotional investing is to rely on a clearly defined plan. When you have predetermined goals, timelines, and strategies, you are less likely to be swayed by sudden changes in the market. A written investment plan serves as a stabilizer. It reminds you of your principles when emotions try to pull you away. For example, if your plan is to invest consistently for 20 years, a sudden drop in the market does not shake you because you know your horizon is long. Without a plan, you are vulnerable to every swing of emotion and every wave of opinion. Patience is a quality that protects you from emotional errors. Impulsive decisions often come from the desire for quick results. The disciplined investor accepts that true growth takes time. Wealth is built gradually through steady, consistent action. By embracing patience, you remove the urgency that drives emotional reactions. You understand that temporary fluctuations do not determine your outcome. The long-term vision is what matters, and patience keeps you aligned with it. A practical method to avoid emotional choices is to create rules for yourself in advance. For example, decide the percentage of your income that will be invested, the type of assets you will focus on, the maximum risk you are willing to take, and the conditions under which you will sell. When these rules are clear, you do not rely on feelings in the moment. Instead, you simply follow your own guidelines. Rules transform uncertain situations into manageable ones because they prevent you from making decisions in a cloud of emotion. Another effective practice is limiting exposure to constant market noise. The more you watch news cycles, predictions, and dramatic headlines, the more emotional pressure you experience. Media thrives on exaggeration, and if you consume it excessively, your decisions will reflect that fear or excitement. Protecting investments sometimes means protecting your mind from overload. Stay informed, but focus only on information that directly supports your plan. Knowledge strengthens, but noise distracts. Resisting emotional decisions also requires humility. Many investors are drawn into risky moves because of overconfidence. When a few decisions go well, they begin to believe they cannot fail. This illusion often leads to reckless actions that end in loss. True intelligence lies in acknowledging that no one can predict markets perfectly. By accepting this, you remain cautious and disciplined. Humility creates balance. It prevents the greed that tempts you to risk more than you can afford. It is also useful to practice detachment from short-term outcomes. If you obsess over daily results, every fluctuation feels like a crisis. Detachment does not mean indifference. It means focusing on the bigger picture. When you step back, you see that small declines are insignificant in the context of decades of growth. Emotional reactions shrink when you learn to zoom out and evaluate your progress on a broader scale. Mindfulness can further strengthen your ability to resist emotional decision-making. Being mindful means staying present and aware without being controlled by impulses. When fear rises, observe it without acting immediately. When greed whispers, recognize it as a passing state. This awareness weakens the power of emotions. You begin to see them as temporary visitors rather than permanent truths. With mindfulness, you gain control over your responses, and your choices become deliberate rather than reactive. Protecting investments also involves preparation for volatility. If you expect markets to always be calm, you will be shocked when they are not. But if you prepare in advance, volatility does not disturb you. Build a portfolio that can withstand fluctuations. Keep reserves for emergencies. Diversify to spread risk. These preparations reduce emotional pressure because you know you are protected. Confidence grows when you are prepared, and with confidence comes calm decision-making. Another important element is learning from past mistakes. Many people repeat emotional errors because they never examine them. If you panic-sold in the past, reflect on what drove that choice and what the result was. If you chased an overhyped stock, study how excitement clouded your judgment. By analyzing your history, you create awareness that prevents repetition. Every mistake can become a lesson that strengthens your discipline if you are willing to reflect honestly. It is equally important to separate identity from investments. Many investors tie their self-worth to their financial results. When they win, they feel proud, and when they lose, they feel ashamed. This emotional attachment clouds judgment. Investments are tools, not reflections of personal value. By separating identity from outcomes, you remove ego from decision-making. This allows you to think clearly and act based on principles rather than pride or insecurity. Having long-term perspectives also helps protect against emotional errors. When your horizon is decades, temporary downturns lose their power to frighten you. But when your focus is narrow, every dip feels catastrophic. Shifting perspective from days to years transforms the way you experience volatility. The intelligent investor always thinks in long horizons, and that perspective naturally reduces emotional reactions. Building habits of reflection can further support you. Take time each week to review your decisions and ask whether they were guided by strategy or emotion. This practice of self-examination sharpens awareness and strengthens discipline. Over time, you begin to recognize patterns in your thinking. You notice when you are vulnerable to fear, when excitement tempts you, or when stress influences your judgment. This knowledge equips you to resist emotional impulses before they become actions. Relationships can also influence emotions. If you surround yourself with people who constantly react to market shifts, you will feel pressure to do the same. Protecting investments sometimes requires protecting yourself from negative influences. Spend time with disciplined individuals who remain calm in uncertainty. Their stability reinforces your own. Environment shapes behavior, and choosing the right environment shields you from unnecessary emotional turbulence. At times, the best way to avoid emotional mistakes is to slow down. Quick decisions often arise from emotional pressure. By delaying action, you give yourself time to think clearly. For example, instead of buying or selling immediately after hearing news, wait and reflect. Often, you will discover that the initial emotional reaction was exaggerated. Time allows reason to replace impulse. Ultimately, protecting investments is not only about numbers, but about character. It requires self-control, patience, and resilience. Every time you resist an emotional decision, you strengthen your discipline. Over time, you become less reactive and more strategic. The market will always test your emotions, but if you master yourself, you cannot be easily shaken. The disciplined investor understands that success is not about predicting every movement, but about remaining steady in the face of uncertainty. By creating clear plans, setting rules, practicing patience, and cultivating awareness, you protect your investments from the greatest danger, not external forces, but your own uncontrolled emotions. Financial security is built by those who can remain calm while others panic, who can stay rational while others are driven by greed, and who can follow principles even when emotions urge them to abandon them. Protecting investments by avoiding emotional decision-making is not just a technique, it is a lifelong discipline that secures both financial stability and peace of mind. Chapter 4. Strengthen patience to let investments grow over time. Patience is one of the rarest qualities in investing, yet it is the very foundation that separates those who succeed from those who struggle. The nature of financial growth is slow, steady, and often invisible in the early stages, which makes patience difficult to maintain. Many people enter the world of investing with an eagerness to see results quickly, but that eagerness can become their greatest obstacle. True wealth does not grow overnight. It matures through time, compounding and discipline. Strengthening patience is not simply about waiting, it is about learning to trust a process that works in the background, often without immediate evidence of progress. When you put your money to work, it begins a journey that resembles the growth of a tree. You plant the seed, you nurture it, but for a long time you see nothing above the surface. The temptation is to dig up the seed to check on its progress, yet doing so destroys the very growth you seek. Investments require the same restraint. Your role is not to interfere constantly, but to remain disciplined and allow time to do what short-term action cannot. This requires faith, not blind faith, but faith backed by principles, knowledge, and a clear understanding that the market rewards consistency more than impatience. The reason patience is difficult to develop is because the human mind is wired for immediacy. We are conditioned to seek results quickly, and when they do not appear, anxiety builds. This is especially true in a financial system where markets fluctuate daily. A single news headline can cause fear, and a temporary dip in stock prices can push an investor to abandon their plan. The key to overcoming this tendency is to shift your perspective from days and weeks to years and decades. Once you see investing as a lifelong journey rather than a quick race, your emotions lose their grip, and patience becomes your natural ally. Consider the principle of compounding. Compounding works silently in the background, multiplying results over time. At first, the effect seems small and almost insignificant. You may invest for years and see modest returns. But as time goes on, growth accelerates and the numbers become powerful. This exponential growth only reveals itself when patience is sustained long enough. Those who give up early, withdraw their investments, or chase quick profits cut themselves off from the most powerful force in wealth creation. Patience allows compounding to reach its full potential, and once you understand this, waiting no longer feels like a sacrifice. It feels like strategy. Another reason patience is essential is because markets are not predictable in the short term. There will always be cycles of growth and decline, sometimes caused by global events, sometimes by shifts in industries, and sometimes simply by the nature of supply and demand. If you expect a straight line upward, you will be disappointed. But if you accept that dips are part of the journey, you can remain calm during volatility. Patience helps you see beyond the noise. Instead of reacting to temporary setbacks, you learn to trust that long-term growth trends are stronger than short-term disruptions. History has shown repeatedly that markets recover, that industries evolve, and that disciplined investors are rewarded when they stay the course. Strengthening patience is not passive. It is an active practice of controlling your impulses, managing your expectations, and reminding yourself of your larger vision. One practical way to cultivate patience is to set clear investment horizons. Decide from the beginning whether an investment is meant for 5 years, 10 years, or even longer. When you remind yourself of this timeline, daily fluctuations lose their power over you. A short-term drop does not matter when your horizon is measured in decades. Another practice is to avoid checking your investments too frequently. Constantly monitoring performance creates unnecessary stress and tempts you to act impulsively. Instead, schedule specific times to review your portfolio and make adjustments only when they are justified by long-term goals, not short-term emotions. Patience also requires humility. It means accepting that you cannot control everything. You cannot predict the exact timing of market highs or lows, nor can you guarantee outcomes in the short run. What you can control is your behavior, your discipline, and your ability to remain committed. This humility prevents you from trying to outsmart the market, and instead grounds you in principles that have stood the test of time. Those who lack patience often try to chase trends, time the market, or switch strategies constantly, but this usually leads to losses. The patient investor recognizes that consistency, even if it feels slow, is the true path to stability and growth. A useful exercise is to connect your patience with your purpose. Ask yourself why you are investing. Is it to secure retirement, to provide for your family, to create freedom in the future? When you attach your investments to a meaningful reason, waiting becomes easier. Every time you resist the urge to sell prematurely, you remind yourself that you are working towards something larger than the discomfort of the present moment. Patience gains strength when it is tied to meaning. There will always be stories of people who made quick fortunes by timing a market surge or getting lucky with a sudden opportunity. These stories create illusions and tempt you to compare your steady progress with their seemingly instant success. The truth, however, is that such cases are rare, and often those same individuals lose just as quickly as they gained. Chasing these stories erodes patience. Instead of focusing on what others achieve in the short term, focus on what you can achieve over the long term by being consistent. Comparison is the enemy of patience. Your journey is your own, and the discipline to stay on course matters far more than chasing after someone else's moment of luck. Another aspect of patience is accepting that mistakes will happen. You may invest in something that does not perform as expected, or you may experience a temporary loss. The impatient mind sees this as failure and rushes to correct it. The patient mind sees it as a natural part of the process and continues forward with wisdom gained. Patience turns setbacks into lessons rather than disasters. Over time, this mindset builds resilience, and resilience reinforces your ability to remain steady through ups and downs. Patience is also deeply connected to emotional balance. When you practice patience, you train yourself to respond thoughtfully rather than react impulsively. You develop an inner calm that is not shaken by every shift in the market or every piece of unsettling news. This calmness extends beyond investing and becomes a part of how you approach challenges in life. Strengthening patience in finances often leads to patience in relationships, in career, and in personal growth. It becomes a character trait that serves you everywhere. The path to long-term success is rarely dramatic. It is built through small, consistent actions repeated over time, guided by patience and discipline. The world will always try to convince you that you need results now, that waiting is a weakness, and that action is always better than inaction. But in investing, restraint is often the wisest form of action. By strengthening patience, you allow time to be your ally, and time is the most powerful ally you will ever have. In the end, patience is not just about waiting for wealth to grow. It is about trusting yourself enough to remain committed to your plan. It is about developing the wisdom to value the future over the present. It is about building the strength to resist unnecessary action and the discipline to stay the course. When you strengthen patience, you align yourself with the natural rhythm of growth. You stop fighting against time and instead let time work in your favor. And when you reach the point where your investments bear fruit, you will see that patience was not just a virtue, it was the very strategy that made everything possible. Chapter 5. Focus on steady progress instead of chasing quick returns. Steady progress is the cornerstone of lasting success in investing, and it requires a mindset that values consistency over immediate gratification. The desire for quick returns often leads to risky decisions, impulsive trades, and unnecessary stress. Many investors become impatient when their efforts do not yield instant results, and they shift strategies frequently, chasing the next big opportunity. This behavior usually undermines long-term growth. Focusing on steady progress means committing to a plan, taking deliberate steps every day, and understanding that small, consistent actions compound over time to produce significant results. True financial growth does not come from luck or from timing the market perfectly. It emerges from a disciplined approach that prioritizes regular contributions, informed choices, and gradual improvements. When you focus on steady progress, you recognize that each incremental gain, no matter how small, contributes to your larger goal. This perspective shifts your attention from unpredictable short-term fluctuations to controllable actions you can repeat consistently. Every day you invest thoughtfully, monitor your budget, and adjust your portfolio according to principles rather than impulses. You are building a foundation that will support wealth in the long run. One of the first steps in focusing on steady progress is to establish realistic expectations. Many people fail because they expect extraordinary results in a short period. Unrealistic expectations create frustration and tempt investors to take shortcuts that increase risk. By understanding that sustainable growth is gradual, you allow yourself to remain patient, make rational decisions, and resist the urge to chase quick returns. Success becomes a marathon rather than a sprint, and this mindset shields you from common pitfalls. Consistency is another critical element. Regular, disciplined action produces compounding effects. Small contributions to savings or investments, repeated over months and years, lead to exponential growth. This principle applies not only to finances, but to habits, knowledge, and skills that support your financial journey. Daily or weekly attention to your goals, even in minor ways, builds momentum and creates a pattern of success. Over time, the accumulation of consistent effort outweighs sporadic bursts of high-intensity action. Focusing on steady progress also requires careful risk management. Impulsive decisions often arise from the temptation to achieve high returns quickly, which usually involves higher risk. The intelligent investor understands that controlling risk is more important than chasing the highest possible gains. By evaluating potential investments carefully, diversifying your portfolio, and adhering to your risk tolerance, you protect your progress while allowing growth to continue at a sustainable pace. Risk control is a tool that supports steady advancement rather than hasty speculation. Patience and discipline reinforce steady progress. When you resist the urge to react to short-term market changes, you maintain alignment with your long-term strategy. Each decision becomes a deliberate step toward your overarching goals, rather than a reaction to temporary circumstances. The ability to stay calm and rational while others panic or chase trends is one of the most powerful advantages a disciplined investor can develop. A practical approach is to set measurable incremental milestones. Breaking long-term objectives into smaller, achievable targets allows you to monitor progress regularly and maintain motivation. For instance, if your goal is to build a substantial investment portfolio over a decade, define annual or quarterly targets. These benchmarks provide feedback, helping you assess whether your strategies are effective and giving you a sense of accomplishment along the way. Incremental progress reinforces consistency and builds confidence. Avoiding distraction is another key factor. The financial world is filled with noise, daily news, sensational reports, and stories of overnight success. Chasing every trend or reacting to every headline disrupts steady progress and leads to erratic decision-making. Focusing on long-term goals allows you to filter out distractions and concentrate on actions that truly matter. Discipline in attention is as crucial as discipline in action. It ensures that your energy and resources are devoted to steps that contribute to sustainable growth rather than temporary excitement. Education and skill development support consistent advancement. Understanding how investments work, staying informed about market principles, and continually improving your financial literacy empower you to make confident decisions. When your actions are informed, deliberate, and principled, progress becomes predictable rather than speculative. Continuous learning reinforces steady development, allowing you to refine strategies, anticipate challenges, and strengthen your decision-making process over time. Another element of steady progress is adaptability. Life is unpredictable, and financial plans must accommodate changes in circumstances, opportunities, and priorities. Adaptation does not mean abandoning principles for impulse, but it does require flexibility within a disciplined framework. By making adjustments strategically and systematically, you maintain momentum without succumbing to reactive behavior. This balance between consistency and adaptability ensures that your progress remains uninterrupted, even in dynamic conditions. Building routines that support growth is critical. Establishing habits such as monthly portfolio reviews, automatic savings contributions, and regular budget assessments creates a system that drives steady progress. Habits reduce reliance on willpower and motivation, which can fluctuate daily. Systems enable disciplined action without constant deliberation, ensuring that incremental steps toward your goals occur automatically. The power of routines is that they turn intention into consistent execution, bridging the gap between planning and results. The emotional benefits of focusing on steady progress are significant. When you commit to a gradual, disciplined path, anxiety about volatility diminishes. You feel more in control, confident, and empowered. Success becomes a result of effort and principle rather than luck or timing. This mindset builds resilience, making you less susceptible to panic, envy, or impulsive behavior. Emotional stability strengthens your ability to sustain progress, even when outcomes are delayed or uncertain. Tracking results is essential to maintaining focus on steady growth. Monitoring metrics such as portfolio performance, savings rates, and investment returns allows you to measure progress objectively. Regular tracking prevents complacency and reinforces accountability. It also helps identify areas for improvement, ensuring that each step contributes to long-term objectives. When you can see progress clearly, patience and discipline are reinforced, and the temptation to chase quick wins loses its appeal. Celebrating incremental achievements fuels motivation. Each milestone, no matter how small, validates your efforts and demonstrates that steady work produces results. Recognizing progress encourages persistence, reinforces habits, and nurtures a positive relationship with the investment process. This practice transforms the journey into a series of meaningful experiences rather than a distant, abstract goal. Each small success is evidence that your approach works, reinforcing your commitment to consistency over impulsivity. It is important to cultivate the mindset that wealth is a process. Viewing investing as a sequence of deliberate actions rather than a series of random outcomes shifts focus from immediate gratification to sustainable growth. This perspective encourages patience, informed decision-making, and resilience. You learn to appreciate the value of compounding efforts, risk management, disciplined routines. The understanding that results are earned gradually empowers you to remain consistent, even when progress is not immediately visible. Focusing on steady progress strengthens character. It teaches restraint, strategic thinking, and the value of preparation. The disciplined approach develops a sense of mastery, as you recognize that long-term success is the product of deliberate choices rather than chance. You learn to navigate uncertainty with calm and confidence, understanding that your consistent actions create results over time. This principle extends beyond investing, influencing your habits, career, relationships, and personal development. Ultimately, choosing steady progress over quick returns ensures durability. Quick gains are often temporary and unstable, while gradual, consistent effort produces sustainable growth. By prioritizing steady advancement, you safeguard against reckless decisions, preserve capital, and create a reliable path toward your financial goals. Each thoughtful step accumulates, compounding not only wealth, but also wisdom, confidence, and self-discipline. Commitment to steady progress transforms the way you approach every financial decision. You no longer react to short-term excitement or panic. Instead, you act with purpose, consistency, and strategic foresight. Over time, these repeated, disciplined actions compound, producing results that far exceed what could be achieved by chasing fleeting opportunities. Steady progress is the engine of lasting success, and those who embrace it develop not only wealth, but the character and discipline necessary to sustain it indefinitely. Chapter 6. Learn from failures and adjust your strategies wisely. Failures are inevitable on the path to financial growth, yet they are not the end of the journey. They are feedback, evidence of what needs adjustment, and opportunities for learning. Many investors fear mistakes because they associate them with loss or inadequacy, but the intelligent investor understands that errors are a natural part of the process. Avoiding failure entirely is impossible, but responding wisely to mistakes distinguishes those who succeed from those who repeat the same errors. Learning from failures requires honest self-reflection, analysis, and a willingness to adapt. The first step in learning from failures is acknowledging them without denial or excuses. It is tempting to blame external factors, the market or circumstances beyond control, but such deflection prevents growth. True learning begins when you accept responsibility for the decisions you made and the outcomes that resulted. By examining your choices critically, you gain insight into your behavior patterns and blind spots. This clarity is essential for refining your strategies and preventing the same errors in the future. Once a failure is acknowledged, it must be analyzed methodically. Ask what went wrong, why it happened, and what signals were missed. Distinguish between controllable factors and external forces. Did you act impulsively or without enough information? Did you overestimate your understanding of an investment? Were your expectations unrealistic? By dissecting the failure with a clear mind, you extract lessons that can guide future decisions. Each misstep becomes a data point, a teacher providing wisdom that only experience can offer. Adjustment is the next critical step. Learning from failures is meaningless if you do not modify your strategies accordingly. Incorporate the insights gained into your planning and execution. For example, if a particular investment strategy consistently underperforms, analyze why and explore alternative approaches. If emotional reactions led to premature selling, implement rules or systems to prevent repetition. Adaptation requires courage and discipline because it involves change, but it is essential for continuous improvement. Stubbornly persisting with a flawed strategy guarantees repeated setbacks. Embracing a mindset of growth is vital when responding to failures. View mistakes as opportunities rather than threats. Each failure contains information about weaknesses, gaps in knowledge, or flawed assumptions. The intelligent investor reframes setbacks as part of the learning curve and a necessary component of long-term success. By adopting this perspective, failures lose their sting and become motivating forces rather than sources of discouragement. The focus shifts from what was lost to what can be gained through learning and adjustment. Developing systems to prevent repeated errors strengthens resilience. Document lessons learned, track recurring patterns, and create specific rules or checklists for decision-making. For example, if impulsive investing caused past losses, establish a protocol that enforces research, risk assessment, and reflection before any action. Systems transform experience into consistent practice. They reduce the chance of emotion-driven mistakes and provide a structure for continuous improvement. Over time, these habits form a foundation for smarter, more confident decision-making. Reflection must be honest and thorough. Superficial evaluations do little to change behavior. Examine not only what happened, but also how you responded emotionally. Did fear, greed, or impatience influence your actions? Were you reactive rather than proactive? Awareness of your own tendencies is as important as understanding external factors. The more honest your self-examination, the more valuable the lessons you extract. Failure is a mirror that reveals not just the external error, but also the internal habits that need refining. Learning from failures also requires patience. Insights often emerge gradually, and change does not happen overnight. Avoid the temptation to make drastic, immediate adjustments without careful consideration. Small, deliberate refinements based on analysis are more effective than reactive overhauls. Patience ensures that lessons are integrated thoughtfully and that adjustments are sustainable rather than impulsive. Over time, cumulative improvements create a more resilient and capable approach to investing. Another important principle is separating ego from learning. Many people avoid admitting mistakes because they fear looking incompetent or weak. This defensiveness blocks growth. True intelligence in investing involves humility, the recognition that no one can predict outcomes perfectly and that errors are inevitable. Humility allows you to absorb feedback objectively and make adjustments without ego-driven resistance. When the focus is on progress rather than pride, failures become invaluable teachers rather than sources of shame. Seeking external perspectives enhances the learning process. Mentors, advisors, or peers can provide insights that you may overlook. An external viewpoint can reveal biases, assumptions, or blind spots that internal reflection misses. Constructive feedback complements self-analysis and accelerates growth. Engaging with knowledgeable individuals expands understanding, challenges your thinking, and guides more informed adjustments. Learning is accelerated when combined with disciplined mentorship or consultation. Documenting failures and responses creates a practical reference. Maintaining a log of mistakes, their causes, and the corrective actions taken allows you to track patterns over time. This record provides clarity on which strategies work, which habits need changing, and which circumstances consistently produce risk. Having a tangible reference also reduces the likelihood of repeating the same errors, as you can review prior experiences before making new decisions. Documentation transforms experiential learning into a lasting resource. Resilience is reinforced through learning from failures. Each setback faced and corrected builds confidence in your ability to navigate challenges. Knowing that a mistake does not define your trajectory, but rather contributes to it, empowers you to continue with courage. Resilient investors maintain focus even after disappointment because they understand that every experience, whether positive or negative, contributes to long-term competence. This mindset ensures that temporary losses do not derail overall progress. It is essential to differentiate between failures that require adjustment and those caused by uncontrollable circumstances. Not every setback indicates a flawed strategy. Market fluctuations, economic conditions, and unforeseen events will affect outcomes. Wisdom lies in recognizing what you can influence and what lies beyond control. Adjustments should target factors within your ability to manage. Accepting uncontrollable outcomes without self-reproach preserves energy for meaningful improvements and prevents unnecessary frustration. Learning from failures also requires action. Insights alone are insufficient. You must implement changes based on what you discover. This may include revising investment plans, improving research methods, or developing better emotional control. Without action, knowledge remains theoretical. The intelligent investor converts learning into behavior, ensuring that mistakes produce real improvement. Action completes the cycle of failure, reflection, and adjustment, turning setbacks into forward momentum. Cultivating a mindset that embraces experimentation can further support growth. Every investment involves uncertainty, and not every decision will succeed. When you view each choice as an experiment, failures become part of the process rather than catastrophic outcomes. This perspective encourages calculated risk-taking, innovation, and adaptation. Treating decisions as experiments allows learning to happen naturally, without fear or paralysis. Each failure is data that informs the next experiment. Maintaining composure in the face of failure is critical. Emotional reactions can cloud judgment and lead to compounding mistakes. By responding calmly and rationally, you preserve clarity and ensure that adjustments are based on analysis rather than impulse. Composure allows failures to be converted into lessons rather than regrets. Emotional control enhances the quality of future decisions and reinforces long-term discipline. Ultimately, learning from failures and adjusting strategies wisely transforms challenges into advantages. Each mistake, once analyzed, understood, and integrated into a refined approach, strengthens your ability to navigate future uncertainties. The intelligent investor views failure not as a defeat, but as a guide toward improvement. Over time, this mindset cultivates wisdom, resilience, and a disciplined approach that consistently produces better outcomes. Growth is not linear, but those who embrace failures as lessons continually move closer to mastery. Success is built not on avoiding mistakes, but on the ability to respond to them thoughtfully. By reflecting honestly, implementing changes, seeking feedback, and maintaining composure, you create a cycle of continuous improvement. Each failure contributes to knowledge, strategy, and confidence, reinforcing a path toward financial stability and long-term growth. Learning from failures is a lifelong practice that shapes character, sharpens judgment, and empowers intelligent decision-making, ensuring that setbacks become stepping stones rather than stumbling blocks. Chapter 7. Study successful investors and apply their proven principles. Learning from successful investors is one of the most efficient ways to accelerate your growth as an investor. Their experiences, decisions, and strategies serve as a roadmap, providing insight into what works and why it works. The intelligent investor does not simply admire success from afar, but actively studies the methods behind it. Understanding patterns, principles, and habits that have consistently produced results allows you to apply these lessons to your own financial journey. Success leaves evidence, and by analyzing that evidence, you can reduce mistakes and enhance your decision-making process. Start by examining the mindset of proven investors. Most successful investors share a disciplined approach, patience, and long-term vision. They do not react impulsively to market fluctuations or short-term trends. Instead, they operate from a framework of principles, maintaining consistency even in uncertain conditions. Emulating this mindset requires observing not only the outcomes, but also the decision-making processes that produce them, how they assess risk, evaluate opportunities, and maintain emotional control can guide you toward better judgment in your own investments. Another critical principle to study is their commitment to research. Successful investors dedicate substantial time to understanding industries, companies, and market dynamics. They read extensively, analyze financial statements, and monitor relevant trends without allowing noise to distract them. This deep knowledge forms the foundation of informed decision-making. By committing yourself to consistent learning and thorough research, you adopt a practice that enhances the quality of your investments and minimizes reliance on guesswork or luck. Observation of how investors manage risk is equally important. Most proven investors diversify strategically, set margins of safety, and avoid overexposure to high-risk assets. They understand that preservation of capital is as important as generating returns. Applying these principles involves identifying risks in your portfolio, establishing safeguards, and avoiding speculative behavior that threatens long-term stability. By mirroring this cautious yet confident approach, you create a resilient framework that withstands volatility and uncertainty. Successful investors also demonstrate patience and long-term thinking. They understand that wealth grows over years and decades rather than weeks or months. By holding positions that align with their research and principles, they allow time and compounding to work in their favor. Applying this lesson requires resisting the temptation to chase immediate returns and maintaining a focus on sustainable growth. Long-term discipline consistently outperforms short-term speculation, and understanding this principle transforms how you approach every financial decision. Learning from failures of these investors is as valuable as studying their successes. Every investor, no matter how experienced, has encountered mistakes. What sets successful individuals apart is their ability to analyze failures, extract lessons, and adjust strategies without losing composure. By studying their mistakes, you gain insight into common pitfalls, emotional challenges, and decision-making traps. Applying this knowledge prevents you from repeating the same errors and strengthens your own capacity for resilience and adaptation. It is also essential to study the habits that support consistent success. Many leading investors have routines that prioritize organization, reflection, and continuous improvement. They track performance, evaluate progress, and refine strategies systematically. Adopting similar habits ensures that your efforts are structured, deliberate, and measurable. Regular assessment of your actions, combined with disciplined execution, transforms good intentions into consistent results and reinforces the principles you are learning from successful mentors. Understanding their approach to market psychology provides another layer of insight. Successful investors recognize that human behavior drives markets as much as financial fundamentals. They study trends of fear and greed, avoid herd mentality, and remain rational when others panic or chase excitement. Applying this lesson means developing awareness of emotional influences on the market and your own behavior. By remaining calm and deliberate, you position yourself to take advantage of opportunities that arise when others act impulsively. Emotional control is a skill that amplifies the practical strategies you learn from observation. Networking and seeking guidance from experienced investors can also accelerate your growth. Conversations, mentorships, and studying writings or interviews provide nuanced insights that cannot always be captured from data alone. Exposure to multiple perspectives helps you refine your understanding, challenge assumptions, and adopt strategies that align with your goals. Learning from those who have achieved measurable results allows you to shortcut common errors and implement proven approaches efficiently. Adopting the principle of incremental improvement is another lesson from top investors. They rarely rely on sudden breakthroughs or dramatic changes. Instead, they make small, consistent adjustments based on careful analysis and evidence. By focusing on continuous improvement, you gradually enhance your strategy, knowledge, and performance. Incremental progress compounds over time, producing results that far exceed isolated, reactive actions. Applying this principle ensures that your growth is sustainable and resilient. Ethics and integrity are additional components observed in successful investors. Many maintain transparency, honesty, and principled decision-making. They avoid shortcuts, schemes, and speculative behavior that can jeopardize long-term credibility. Applying these values in your own practice ensures that your progress is stable and that your decisions are aligned with sound judgment rather than expediency. Trustworthiness and principled action are qualities that reinforce sustainable success. Documentation of insights and strategies is a practice many successful investors maintain. Keeping detailed records of decisions, rationales, and outcomes allows them to review and refine their approaches over time. This method of reflection and analysis creates a feedback loop that continuously improves decision-making quality. By incorporating a similar practice, you create a personalized system for learning, adjusting, and optimizing your strategies based on concrete evidence rather than memory or assumption. Studying successful investors also teaches you to remain flexible while adhering to principles. Markets evolve, industries change, and new information becomes available. Top investors adapt their strategies without abandoning core values. This balance between flexibility and consistency ensures that you respond to new circumstances effectively while maintaining a foundation of proven principles. Applying this lesson involves periodic review of strategies and readiness to make calculated adjustments when necessary. The principle of focus is evident in successful investors. They concentrate on opportunities they understand, avoiding distractions or ventures beyond their expertise. Specialization enhances the quality of decisions and reduces exposure to avoidable risks. By focusing your efforts on areas where you have competence and confidence, you maximize the potential for consistent, favorable outcomes. Learning to say no to opportunities outside your scope is a key lesson in disciplined investing. Patience, research, risk management, ethical principles, incremental improvement, focus, and reflection form a cohesive framework when learned from proven investors. Applying these principles transforms both strategy and mindset. You begin to see investment as a discipline grounded in careful thought rather than chance or speculation. The insights gained from observation create a practical guide for action, helping you navigate uncertainty and make decisions that compound value over time. Ultimately, studying successful investors is not about imitation, it is about integration. Each principle, habit, and strategy should be adapted to your unique circumstances, goals, and personality. The intelligent investor extracts the essence of proven approaches and tailors them into a framework that supports their own growth. By combining observation with thoughtful application, you accelerate learning, reduce mistakes, and cultivate the qualities necessary for sustained success. Applying the lessons of successful investors produces more than financial gain. It develops discipline, resilience, emotional control, and strategic thinking. These qualities extend beyond investing, enhancing decision-making in personal life, career, and long-term planning. Consistent study, reflection, and application of proven principles create a cycle of growth that compounds like capital in a well-managed portfolio. The knowledge gained from others becomes a multiplier for your own development, ensuring that each step you take is informed, deliberate, and directed toward long-term achievement. Chapter 8. Improve knowledge daily to make smarter investment choices. Daily improvement of knowledge is the most reliable path to making smarter investment choices. Every decision you make in investing relies on the information you possess, your understanding of markets, and your ability to interpret trends accurately. Without continual learning, even the most disciplined strategies can falter. Knowledge is not static, and markets are constantly evolving. Staying informed, expanding your understanding, and refining your skills are essential to maintaining an edge and avoiding costly mistakes. Developing a habit of learning begins with dedication. Setting aside time each day to read, analyze, and reflect on financial information builds a foundation that compounds over time. This practice can include reviewing market reports, studying company fundamentals, exploring economic indicators, or reading books by respected investors. The focus should not be on quantity alone but on depth and comprehension. True knowledge allows you to understand the reasons behind market movements rather than reacting blindly to headlines. Active learning enhances retention and application. It is not enough to consume information passively, you must engage with it critically. Ask questions, challenge assumptions, and relate new insights to your existing knowledge. For example, when studying a company, consider how its financial health, competitive position, and industry trends influence its potential growth. By connecting theory with practice, you develop the ability to apply knowledge effectively in real investment decisions. Improving knowledge daily also involves understanding risk. Markets can be unpredictable, and every investment carries potential downsides. Educating yourself about risk management techniques, portfolio diversification, and market volatility equips you to make choices that balance potential rewards with acceptable exposure. Knowledge reduces uncertainty and empowers you to act with confidence rather than fear or impulse. This understanding is a protective layer that strengthens decision-making in all financial situations. The intelligent investor recognizes that knowledge extends beyond numbers. It includes awareness of behavioral finance, market psychology, and global economic factors. Understanding human behavior helps you anticipate trends driven by emotion rather than fundamentals. Studying economic policies, geopolitical events, and technological developments provides context that informs strategic choices. Knowledge of multiple dimensions of investing creates a comprehensive perspective, allowing you to identify opportunities others may overlook. Consistency is critical when improving knowledge. Even small daily efforts accumulate into significant expertise over months and years. Regular engagement ensures that you remain aware of shifts in the market and continuously refine your analytical skills. This ongoing process prevents stagnation and keeps your investment strategies relevant and adaptable. The disciplined approach to daily learning mirrors the disciplined approach needed in managing investments themselves. Applying knowledge is as important as acquiring it. The insights you gain must translate into actionable strategies. For instance, understanding a company's growth potential should lead to informed decisions about buying, holding, or selling shares. Analytical skills enable you to differentiate between short-term noise and long-term value. Knowledge without action is wasted potential, while thoughtful application transforms information into measurable results. Feedback loops reinforce learning. Regularly reviewing past decisions and comparing them with outcomes helps identify strengths and weaknesses. Did your understanding of a sector correctly predict its performance? Were your assumptions accurate? Reflection ensures that mistakes become opportunities for growth and that successful decisions are reinforced. Over time, this iterative process sharpens judgment, improves predictive abilities, and enhances confidence in your choices. Technology offers tools to accelerate learning. Accessing financial databases, market analysis software, and educational platforms allows you to study patterns, analyze historical data, and simulate investment scenarios. These resources provide insights that are difficult to obtain through observation alone. Leveraging technology enhances your analytical capabilities and ensures that your knowledge keeps pace with the complexity of modern markets. Engaging with a community of knowledgeable investors can expand understanding further. Discussions, forums, mentorships, and study groups expose you to diverse perspectives and approaches. Listening to experiences, asking questions, and debating ideas challenges your thinking and uncovers blind spots. Knowledge shared and tested in dialogue is often more robust than knowledge acquired in isolation. Collaboration accelerates growth and fosters a network of informed support. Balancing breadth and depth of knowledge is essential. You need a wide understanding of general market principles while developing deep expertise in areas where you invest. For example, understanding global economic trends provides context, while knowing the details of specific industries or companies allows precise decision-making. This balance ensures that your investments are informed, strategic, and resilient to unforeseen challenges. Discipline in daily learning fosters mental flexibility. Markets change rapidly, and old assumptions can become outdated. By consistently updating your knowledge, you maintain the ability to pivot when conditions shift. Mental flexibility allows you to respond strategically rather than react emotionally, which is a hallmark of intelligent investing. The continuous practice of learning prepares you to adapt to new information while maintaining alignment with long-term objectives. Curiosity is a driving force behind knowledge acquisition. The desire to understand why markets behave as they do, how companies operate, and what trends will shape the future keeps your engagement active. Curiosity prevents complacency and ensures that learning is dynamic rather than mechanical. Investors who cultivate curiosity approach challenges with creativity and insight, identifying opportunities that others might miss. Prioritizing credible sources is another key aspect of improving knowledge. Distinguish between opinion and evidence, hype and analysis, speculation and research. Reliable data forms the foundation for intelligent decisions, while misinformation can mislead and create unnecessary risk. Developing the ability to evaluate sources critically strengthens analytical skills and reduces exposure to poor choices. Time management is vital for daily knowledge improvement. Even small, focused sessions of study are more effective than sporadic, long, unfocused periods. Establishing a routine ensures that learning becomes habitual and continuous. Consistency over time compounds understanding and gradually builds the expertise necessary for superior decision-making. The discipline to allocate time for learning mirrors the discipline required in investing itself. Learning from historical patterns is essential. Studying past market cycles, investment successes, and failures reveals recurring principles and behaviors. History does not repeat exactly, but it provides a reference that informs rational expectations. By integrating historical insight with current information, you increase the probability of making intelligent, informed choices. Knowledge of precedent sharpens judgment and reduces reliance on guesswork. Improving knowledge daily also strengthens confidence. When you understand why a decision is made, you act decisively rather than hesitantly. Confidence does not come from certainty but from preparation, research, and understanding. A well-informed investor navigates uncertainty with composure and clarity, making choices that are calculated, deliberate, and strategic. Knowledge builds this confidence incrementally, reinforcing consistent performance over time. Knowledge enhances risk awareness and foresight. Understanding market dynamics, economic indicators, and investment principles allows you to anticipate potential outcomes and prepare accordingly. Awareness of consequences improves planning and ensures that decisions are resilient to volatility. Daily study sharpens your ability to foresee challenges and develop strategies that mitigate them, protecting progress while enabling growth. Finally, the practice of daily knowledge improvement instills a mindset of continuous growth. Every day offers an opportunity to refine understanding, adjust strategies, and enhance decision-making skills. This ongoing commitment ensures that you remain relevant, adaptable, and empowered to make smarter investments consistently. Knowledge transforms uncertainty into calculated opportunity, and when pursued relentlessly, it becomes the most reliable tool for achieving long-term financial success. Chapter 9. Practice self-control to resist unnecessary financial risks. Self-control is one of the most important traits an intelligent investor can develop because it determines the ability to make rational decisions under pressure and avoid unnecessary risks. Many financial losses occur not from a lack of opportunity or knowledge, but from impulsive actions driven by emotion, desire for quick returns, or fear of missing out. Developing self-control means creating the discipline to pause, evaluate, and act deliberately rather than reacting instinctively to market movements or peer pressure. This skill protects your capital, preserves long-term growth, and builds confidence in every decision you make. The first step to cultivating self-control is awareness. You must recognize the impulses that lead to risky decisions, whether they are triggered by excitement, anxiety, or social influence. By identifying these triggers, you can pause before acting and ask whether the decision aligns with your long-term strategy. Awareness creates a space between impulse and action, giving you the ability to choose measured responses instead of being driven by emotion. Establishing clear rules and limits reinforces self-control. Determine thresholds for risk exposure, investment amounts, and acceptable levels of volatility before committing funds. When these boundaries are defined in advance, they act as a safeguard against impulsive behavior. Rules remove the need for constant real-time judgment under pressure, which is when emotions tend to dominate. A disciplined framework allows decisions to be based on principle rather than reaction. Patience strengthens self-control. Financial opportunities will always appear, but not every opportunity is worth pursuing. Learning to wait for situations that meet your criteria helps you avoid hasty choices that could compromise stability. Patience is a form of discipline that ensures you commit resources only when the probability of success aligns with your strategy. It transforms the approach from reactive to intentional, reducing exposure to unnecessary risk. Managing emotions is critical. Fear and greed are the two most powerful emotions influencing financial decisions. Fear can lead to selling prematurely or avoiding opportunities, while greed can drive overinvestment or speculative behavior. Developing emotional resilience allows you to recognize these feelings without letting them dictate your actions. Techniques such as deep reflection, careful analysis, and disciplined planning help maintain composure during market fluctuations. Mindset matters as much as strategy. Viewing financial risk through a rational lens rather than an emotional one reinforces self-control. When you understand that losses are a natural part of investing and that wealth grows gradually, you are less likely to make impulsive choices. A disciplined mindset emphasizes consistency, preparation, and calculated action over reaction. The intelligent investor focuses on probability, logic, and principles instead of chasing immediate gratification or avoiding temporary discomfort. Preparation is another essential component. Anticipating potential challenges and planning responses in advance strengthens control over decisions. When market volatility or unexpected events arise, a predefined plan provides a roadmap for action. This preparation reduces anxiety and prevents reactive behavior that could lead to unnecessary risk. Planning also includes defining exit strategies, diversification approaches, and contingency measures, ensuring that every decision is supported by a rational framework. Developing habits that reinforce restraint improves self-control over time. Regularly reviewing your portfolio, monitoring spending, and adhering to investment principles create routines that limit impulsive actions. Habits transform conscious effort into automatic behavior, allowing disciplined choices to become the default response. Consistent practice of these routines strengthens your ability to resist temptation and maintain alignment with long-term goals. Seeking external accountability enhances self-control. Sharing plans with a mentor, advisor, or peer can create a system of checks and balances. Knowing that your actions will be evaluated encourages measured decisions and reduces impulsivity. External perspectives provide clarity, highlight blind spots, and reinforce adherence to established principles. Accountability transforms self-control from an internal struggle into a supported, structured practice. Avoiding high-risk speculative opportunities is a key application of self-control. Trends promising rapid gains are often accompanied by substantial potential losses. Exercising restraint and evaluating whether the risk aligns with your goals protects your capital. High-return opportunities may seem enticing, but the intelligent investor considers long-term implications and avoids taking unnecessary chances that could undermine progress. Discernment between calculated risk and reckless speculation is a hallmark of disciplined investing. Reflection strengthens self-control by linking actions to outcomes. Regularly reviewing decisions, successes, and mistakes reinforces lessons and informs future behavior. Understanding why certain impulses led to errors or successes allows you to refine judgment and adjust strategies. Reflection ensures that self-control is not theoretical but actively applied and continuously improved over time. The process of examining actions and outcomes creates a feedback loop that develops stronger decision-making habits. Consistency is critical in maintaining self-control. One lapse can erode confidence and lead to cascading mistakes. By committing to disciplined practice every day, you develop reliability in your decision-making. Consistent application of rules, reflection, and preparation ensures that impulsive actions become rare, while deliberate, strategic choices dominate your behavior. Consistency turns self-control into a dependable foundation for long-term success. Limiting exposure to temptations is a practical method to reinforce self-control. Avoid situations, platforms, or environments that encourage hasty decisions. By managing your surroundings and information intake, you reduce the likelihood of succumbing to impulsive behavior. This proactive approach creates a buffer against unnecessary risks and supports deliberate decision-making. Incremental improvement of self-control is achievable through deliberate practice. Small challenges, such as delaying a purchase, waiting before executing a trade, or following a predefined plan without deviation, strengthen discipline over time. Each successful act of restraint reinforces the ability to act thoughtfully in larger, more impactful situations. Gradual development ensures that self-control becomes an integral part of your approach to investing. Visualization and mental rehearsal can support disciplined behavior. Anticipating scenarios where temptation or risk may arise and mentally practicing controlled responses prepares you to act deliberately in real situations. Visualization reinforces habits, strengthens resolve, and reduces reliance on reactive impulses. Mental preparation complements practical strategies, creating a comprehensive approach to managing behavior and risk. Education about risk and probability empowers self-control. Understanding how likely outcomes are, the impact of volatility, and the principles of portfolio management provides a rational basis for decision-making. Knowledge reduces fear and excitement as drivers of behavior and promotes confidence in calculated choices. The intelligent investor leverages understanding to reinforce restraint rather than rely solely on willpower. Finally, self-control produces long-term benefits beyond immediate protection from risk. It cultivates patience, discipline, strategic thinking, and emotional intelligence. Every instance of restraint strengthens the ability to navigate uncertainty, adhere to principles, and build sustainable growth. By practicing self-control consistently, you create a foundation that supports not only financial stability, but also personal development, resilience, and confidence. The disciplined investor thrives because decisions are deliberate, informed, and aligned with long-term objectives rather than short-term impulses. Chapter 10. Track spending habits and cut wasteful expenses consistently. Tracking spending habits and consistently cutting wasteful expenses is one of the most practical ways to strengthen financial stability and build long-term wealth. Understanding where your money goes is the first step toward controlling it. Many people assume they know their spending patterns, but without careful observation, hidden inefficiencies can drain resources over time. Every dollar has the potential to serve your goals if allocated intentionally. By monitoring expenditures and removing unnecessary outflows, you create room for investment, savings, and purposeful spending that aligns with your financial objectives. Begin by recording all expenses meticulously. Every purchase, subscription, and transaction should be noted, no matter how small. This practice reveals patterns that are often invisible in memory alone. When you see the cumulative impact of small, repeated purchases, the reality of waste becomes undeniable. Recording spending is not an exercise in guilt, but a tool for clarity and empowerment. It transforms vague assumptions into precise knowledge that allows informed decisions. Categorizing expenses provides deeper insight. Group your spending into essentials, discretionary items, and luxuries. Essentials cover necessities such as housing, food, utilities, and transportation. Discretionary spending includes entertainment, dining out, and hobbies. Luxuries involve items or services that provide comfort or status beyond basic needs. By breaking down your spending in this way, you can identify which areas offer the greatest potential for reduction without compromising quality of life. Regular review is crucial. Tracking once is insufficient. Habits must be analyzed consistently over weeks and months. Patterns emerge over time, revealing tendencies toward impulsive or unnecessary purchases. This awareness allows you to make targeted changes, such as limiting dining out, unsubscribing from unused services, or negotiating bills. Consistency transforms sporadic insight into actionable intelligence that continuously improves financial behavior. Setting clear spending limits enhances control. After analyzing your habits, establish caps for discretionary categories. Allocate a specific portion of income to non-essential items, while ensuring that savings and investments remain prioritized. Limits provide boundaries that prevent overindulgence and reinforce discipline. They make the process proactive rather than reactive, turning awareness into structured action. Automation supports consistent expense management. Setting up automatic transfers to savings, investment accounts, or bills reduces the risk of overspending. When essential payments are secured and savings are prioritized, discretionary funds are easier to manage consciously. Automation removes the burden of constant decision-making, ensuring that financial priorities are consistently maintained. Evaluate recurring subscriptions and memberships. Many people maintain services they rarely use, draining resources silently. By auditing these expenses regularly, unnecessary costs can be eliminated. Canceling or renegotiating services not only saves money, but also sharpens awareness of habitual spending behaviors. This practice instills a habit of questioning all regular outflows and aligning them with true value. Emphasize value over cost. Not all low-cost purchases are wise, and not all high-cost items are wasteful. Evaluate each expense based on the benefit it provides relative to your goals. This perspective prevents impulsive buying motivated by temporary desire rather than long-term utility. Smart spending focuses on maximizing benefit while minimizing waste, creating efficiency and intentionality in financial behavior. Prioritize needs versus wants. Distinguishing between what is necessary and what is optional reinforces restraint. Essential expenses maintain stability, while wants should be considered carefully and deliberately. Postponing or eliminating non-essential purchases provides resources for investments and savings, creating a direct path toward financial growth. This prioritization encourages mindful decision-making and strengthens long-term discipline. Tracking spending also uncovers hidden inefficiencies. Small daily habits, like frequent coffee shop purchases or subscription overlap, can accumulate into significant loss. Identifying these patterns allows precise adjustments that have substantial impact over time. Even minor reductions, when compounded over months and years, significantly increase available capital for wealth-building activities. Attention to detail in this area magnifies the effect of disciplined spending. Budgeting is a practical tool to maintain awareness. Create a simple plan that allocates income to essential needs, savings, investments, and discretionary spending. Review and adjust the budget regularly to ensure it reflects evolving circumstances and goals. A living budget functions as a roadmap, guiding decisions, reinforcing self-control, and providing a clear picture of financial health. Avoid impulse purchases by creating a waiting period before non-essential spending. Giving yourself time to reflect on whether a purchase aligns with your goals reduces regret and prevents waste. Often, the initial desire fades with thoughtful consideration, preserving resources for higher priority objectives. This habit strengthens self-discipline and reinforces intentional spending behavior. Use tools and technology to enhance tracking. Expense tracking apps, digital statements, and financial software provide real-time insights, trend analysis, and visualization of spending patterns. These tools simplify the process, reduce errors, and provide actionable information that supports consistent monitoring and decision-making. Leveraging technology ensures that expense tracking is efficient, accurate, and continuous. Evaluate lifestyle inflation. As income increases, spending often grows proportionally, eroding potential gains. Maintaining awareness of lifestyle creep allows you to preserve additional income for investment rather than consumption. By consciously limiting increases in discretionary spending as earnings rise, you accelerate wealth accumulation and maintain financial discipline despite changes in income. Cutting wasteful expenses also involves negotiating and seeking alternatives. Lowering utility bills, finding cost-effective service providers, and purchasing smarter through research can reduce expenditures without sacrificing quality. Proactive management ensures that every dollar is used efficiently and reinforces the habit of intentional financial decisions. Reducing costs strategically enhances resources available for growth and security. Regularly reviewing goals ensures that spending aligns with priorities. Financial objectives, whether short-term savings or long-term investment, provide context for evaluating every expense. When purchases are measured against goals, it becomes easier to resist unnecessary spending and focus resources on activities that produce meaningful returns. This alignment strengthens commitment, reduces distraction, and guides disciplined financial behavior. Incorporate accountability by sharing progress with a trusted mentor or partner, discussing habits, reviewing changes, and receiving feedback creates external reinforcement that encourages adherence to financial discipline. Accountability turns tracking from a solitary exercise into a structured, supported process that increases consistency and effectiveness. Tracking and reducing wasteful spending fosters a mindset of conscious resource management. Over time, the practice cultivates awareness, discipline, and strategic thinking that extend beyond finances into other areas of life. It strengthens the habit of evaluating choices carefully, prioritizing long-term benefit, and resisting impulsive behavior. This mindset reinforces personal growth, resilience, and intelligent decision-making. Finally, consistent attention to spending creates compounding benefits. Every dollar saved through conscious management is available for investment or growth, multiplying over time. The habit of monitoring, evaluating, and cutting unnecessary expenses builds financial confidence and creates a sustainable foundation for future prosperity. Discipline in spending, combined with strategic allocation of resources, produces tangible results that reinforce long-term success, independence, and control over financial destiny. Chapter 11. Invest only in areas you fully understand deeply. Investing only in areas you fully understand is a fundamental principle that separates successful investors from those who take unnecessary risks. Knowledge and comprehension of an investment's nature, mechanics, and potential outcomes provide the foundation for making rational, informed decisions. When you step into areas you do not understand, you rely on luck rather than skill, and luck is an unreliable partner in wealth creation. Deep understanding allows you to assess risks accurately, anticipate challenges, and make strategic choices that align with your long-term goals. Begin by identifying sectors, industries, or investment types where you already possess experience or expertise. Your familiarity with the market dynamics, operational mechanisms, and historical performance provides a significant advantage. For instance, someone with a background in technology will have insights into emerging trends, product cycles, and innovation potential. Investing within your area of expertise allows you to analyze opportunities critically and make decisions based on data and understanding rather than speculation. Learning before investing is essential. Even if you have some familiarity with an industry, Investing without thorough preparation exposes you to unnecessary risk. Take time to study company fundamentals, financial statements, competitive positioning, and industry trends. Reading reports, analyzing case studies, and understanding regulatory environments deepen your insight. Knowledge builds confidence, reduces uncertainty, and allows you to act decisively when opportunities arise. Avoid chasing trends outside your understanding. Popular investment themes or fads can be enticing, but success in such areas is rare without deep knowledge. Many investors are tempted by hype or media attention and enter markets they do not comprehend, leading to poor decisions and potential losses. Staying within areas you understand ensures that every decision is informed and deliberate, rather than reactive or impulsive. Assess risk with clarity. When you understand an investment thoroughly, you can identify the potential downside and evaluate whether it aligns with your risk tolerance. Deep knowledge allows you to distinguish between manageable risks and speculative hazards. This clarity ensures that your portfolio is constructed around informed choices rather than assumptions or guesses, creating resilience against volatility and uncertainty. Focus on the underlying value rather than surface appearances. Investments often appear attractive due to short-term trends, marketing, or peer influence. Knowledge of the sector and specific opportunity enables you to analyze intrinsic value objectively. Understanding the drivers of performance, market position, and long-term prospects allows you to see beyond temporary excitement. This analytical approach minimizes mistakes and strengthens decision-making. Diversify thoughtfully within your knowledge areas. While diversification reduces risk, it is most effective when applied to investments you understand. Spreading capital across familiar sectors or companies allows you to balance opportunity and security without entering unknown territory. Knowledge-based diversification is more reliable than random allocation because it relies on insight and informed judgment rather than guesswork. Continuous education is vital. Markets evolve, industries change, and new trends emerge. Staying informed about developments within your areas of expertise enhances decision-making and prevents obsolescence. Subscribe to industry reports, follow key market updates, and learn from the successes and failures of others in the field. Knowledge compounds over time, strengthening both judgment and results. Use critical thinking to evaluate opportunities. Understanding an area deeply allows you to question assumptions, analyze strategies, and anticipate potential challenges. Critical evaluation ensures that investments are based on solid evidence rather than emotion, rumor, or superficial information. The intelligent investor scrutinizes opportunities rigorously, applying reasoning and experience to every decision. Avoid overconfidence by recognizing limits. Even within areas you understand, uncertainty exists. Maintaining humility and acknowledging what you do not know prevents overextension and poor decisions. Deep understanding enhances judgment, but awareness of limitations ensures that risk remains controlled and actions remain measured. Leverage your network to deepen understanding. Conversations with experts, mentors, and peers provide perspectives that enhance your knowledge and reveal insights you may not have considered. Engaging with others helps refine analysis, identify blind spots, and validate assumptions. Knowledge shared in dialogue is often more actionable and nuanced than information obtained independently. Apply what you learn directly to your strategy. Understanding is only valuable when used to guide action. Decisions based on insight allow for precise entry and exit points, informed allocation, and effective risk management. Knowledge turns uncertainty into strategy and increases the likelihood of achieving consistent, long-term results. Track outcomes to reinforce understanding. Evaluate how decisions play out over time to measure accuracy, assumptions, and judgment. Learning from results within your area of expertise strengthens intuition, highlights patterns, and improves future decision-making. This reflection ensures that knowledge translates into practical skill rather than remaining theoretical. Recognize that investing outside your knowledge can lead to stress and errors. Unfamiliar areas increase uncertainty, emotional reactions, and susceptibility to mistakes. Remaining within your understanding maintains confidence and composure, both essential for rational investing. Confidence derived from competence enables calm, deliberate actions even under market pressure. Avoid relying solely on advisors or trends for decisions in areas you do not understand. While guidance can be helpful, true insight comes from personal comprehension. Dependence on external sources without your own knowledge creates vulnerability. Deep understanding empowers you to verify advice, question assumptions, and make independent, informed choices. Focus on long-term performance rather than short-term excitement. Investments within your knowledge base are more predictable and manageable. Deep familiarity allows you to anticipate fluctuations and respond strategically rather than reactively. Patience and persistence in well-understood areas maximize growth potential and reduce unnecessary risk. Maintain simplicity in portfolio construction. Complexity often arises when investors venture into unfamiliar territory. Limiting investments to areas of expertise keeps strategies transparent, manageable, and easier to monitor. Simplicity enhances clarity, reduces errors, and strengthens control over outcomes. Document your analysis and reasoning. Keeping records of why investments were made, the assumptions considered, and the expected outcomes reinforces understanding and provides a reference for future decisions. Documentation transforms experience into structured knowledge that can be applied consistently over time. Reinforce discipline by adhering to your areas of expertise. Avoid the temptation to pursue speculative opportunities outside your understanding. Discipline ensures that each investment is aligned with knowledge, strategy, and long-term objectives, reducing exposure to avoidable risks and enhancing the probability of consistent success. Deep understanding builds confidence, reduces impulsive behavior, and strengthens resilience. When investments are based on knowledge rather than speculation, you can act decisively, manage risks effectively, and maintain composure in fluctuating markets. Knowledge transforms uncertainty into calculated action and empowers you to make strategic decisions that align with your vision for growth. Ultimately, investing only in areas you fully understand establishes a foundation for intelligent decision-making. Knowledge, preparation, critical thinking, discipline, and reflection combine to create a strategic approach that is sustainable, resilient, and effective. By focusing on what you know deeply, you minimize unnecessary risks, enhance outcomes, and cultivate the mindset and habits of a truly intelligent investor. Chapter 12. Stay disciplined even when markets shift and change. Discipline in investing is the cornerstone of long-term success, and becomes especially crucial when markets shift and change unpredictably. Volatility is an inherent part of financial markets, and reacting impulsively to fluctuations often leads to mistakes and lost opportunities. Maintaining discipline requires a steadfast commitment to your strategy, principles, and long-term objectives, regardless of temporary market movements. The ability to stay focused under pressure separates intelligent investors from those who chase trends or react to fear. Begin by defining a clear investment strategy rooted in your goals, risk tolerance, and knowledge. When markets are stable, following a plan may seem straightforward, but its true test comes during periods of uncertainty. A well-articulated strategy provides a roadmap that guides decisions, ensuring that actions are deliberate rather than reactive. Discipline means adhering to this plan, even when external factors tempt deviation. Emotional control is essential. Market shifts trigger fear, greed, and anxiety, all of which can undermine rational decision-making. Recognizing these emotions and their potential impact allows you to respond thoughtfully rather than impulsively. Techniques such as reflection, taking a pause before making decisions, and evaluating actions against your strategy help maintain composure during turbulent periods. Emotional awareness transforms challenges into opportunities for disciplined action. Focus on long-term objectives rather than short-term noise. Sudden market drops or spikes often create an illusion of risk or opportunity that may not align with your overall plan. Keeping sight of your long-term goals allows you to interpret market changes within context, reducing the pressure to make hasty adjustments. Discipline involves patience and confidence that gradual, consistent progress yields superior results over time. Preparation strengthens the ability to remain disciplined. Anticipate potential market fluctuations and determine how you will respond in advance. Establishing rules for rebalancing, adjusting positions, or reviewing strategies ensures that decisions are proactive rather than reactive. When unexpected events occur, a prepared plan provides clarity and direction, reducing the likelihood of rash actions. Consistent monitoring reinforces discipline without fostering impulsivity. Regular review of portfolio performance and alignment with objectives helps maintain awareness, but it should not provoke constant trading based on temporary movements. Observing trends and assessing opportunities with measured analysis ensures that discipline is grounded in informed judgment. Continuous vigilance supports strategic decision-making rather than emotional reaction. Diversification is a practical tool to maintain composure during market shifts. Spreading investments across asset classes, sectors, and regions reduces exposure to volatility in any single area. Diversification provides stability, allowing you to remain committed to your strategy without panic when some components underperform. A balanced portfolio creates the freedom to stay disciplined without overreacting to short-term fluctuations. Education and understanding of market behavior further enhance discipline. Knowledge of historical patterns, economic cycles, and common investor behavior reduces the tendency to respond irrationally. Understanding that markets naturally fluctuate and that downturns are temporary helps maintain perspective. Insight into cycles and trends allows rational interpretation of market movements, reinforcing adherence to your strategy. Establishing clear criteria for action prevents unnecessary deviation. Define what circumstances justify adjustments, such as reaching a specific target, fundamental changes in an investment, or opportunities that fit your strategy. Without objective criteria, decisions are often based on fear, rumor, or emotional reaction. Discipline requires predetermined rules that guide behavior even when external pressures are strong. Avoid comparison with others. Observing peers making rapid decisions or pursuing trending opportunities can create pressure to act outside your strategy. Discipline involves confidence in your plan and an understanding that individual goals and risk tolerances differ. Measuring success against your objectives rather than the actions of others maintains focus and prevents impulsive behavior. Routine and habit support consistency by integrating regular portfolio review, disciplined rebalancing, and planned decision-making into a daily or weekly routine. You create automatic reinforcement of your principles. Habitual adherence reduces reliance on willpower alone and makes disciplined responses more natural, even under stress. Structured routines build resilience and consistency over time. Reflecting on past experiences strengthens commitment to discipline. Analyzing previous market shifts and your responses reveals both strengths and weaknesses. Learning from mistakes and successes reinforces understanding of effective behavior and provides a reference for future decisions. Reflection transforms experience into actionable insight that supports disciplined execution under pressure. Limiting exposure to unnecessary volatility is another method of maintaining discipline. Avoid speculative investments or high-risk ventures that fall outside your strategy. Reducing exposure to high-risk situations lowers emotional stress and prevents impulsive actions. Strategic selection of investments allows adherence to principles even when markets are unpredictable. Maintain a focus on fundamentals. Temporary market changes rarely alter the underlying value of sound investments. By grounding decisions in fundamentals rather than price movements or media narratives, you ensure that actions are rational and aligned with long-term objectives. Discipline relies on objective assessment rather than reactive behavior driven by sentiment. Self-awareness is essential for disciplined investing. Recognize personal tendencies toward impatience, fear, or overconfidence and implement measures to counteract them. Awareness allows proactive management of behavior and reinforces consistent adherence to principles. Self-knowledge provides insight into how external pressures might influence decisions and equips you to act intentionally. Accountability enhances discipline. Sharing your strategy and decisions with a mentor, advisor, or trusted partner creates external reinforcement that encourages adherence to principles. Accountability provides an additional layer of review and ensures that decisions remain aligned with your long-term goals, reducing the temptation to act impulsively. Stay adaptable within your strategy. Discipline does not mean rigidity. If fundamental changes occur in the market, industry, or specific investment, adjustments may be necessary. Adaptation should be deliberate, informed, and consistent with objectives rather than reactive. Intelligent discipline balances steadfastness with flexibility to respond rationally to meaningful developments. Reinforce discipline through incremental goals. Breaking long-term objectives into smaller, measurable targets helps maintain focus and provides motivation. Achieving these milestones reinforces adherence to strategy and builds confidence in decision-making. Incremental success strengthens the habit of disciplined action, making it easier to remain consistent during periods of uncertainty. Focus on compounding results over time. Markets fluctuate daily, but disciplined investors benefit from the cumulative effect of consistent strategies. By staying committed and avoiding emotional reactions, you allow investments to grow steadily. Discipline transforms market shifts from sources of stress into opportunities for maintaining principle-driven actions that generate long-term wealth. Ultimately, staying disciplined when markets shift ensures that your decisions remain guided by reason, preparation, and strategy rather than emotion or external noise. It cultivates resilience, confidence, and consistency, which are essential for long-term success. Discipline allows intelligent investors to navigate volatility, seize opportunities thoughtfully, and maintain alignment with objectives, ensuring that growth is sustainable and intentional over time. Chapter 13. Create safety margins to protect against sudden losses. Creating safety margins is an essential strategy for protecting investments against sudden and unexpected losses. Every financial market carries inherent risks, and no investment is immune to volatility, downturns, or unforeseen events. A safety margin acts as a buffer that allows you to absorb shocks without compromising your long-term objectives. It ensures that your capital is preserved, your portfolio remains stable, and your ability to seize future opportunities is maintained. By intentionally designing investments with built-in protection, you reduce stress, enhance decision-making, and increase resilience during turbulent periods. The first step in establishing a safety margin is understanding the intrinsic value of your investments. Intrinsic value is the real underlying worth of an asset based on fundamentals rather than current market price. By purchasing investments at prices below intrinsic value, you create a cushion that protects against temporary declines. This approach allows room for error, market fluctuations, and unexpected challenges while maintaining the potential for growth. A margin of safety is not just theoretical, it is a practical tool for preserving wealth and reducing vulnerability. Diversification is another critical element of safety margins. Spreading investments across different asset classes, industries, or regions reduces exposure to individual risks. Even if one component of your portfolio underperforms, other assets can offset losses. Diversification does not eliminate risk entirely, but creates a structural buffer that enhances overall stability. The more balanced and carefully selected your investments, the stronger the safety net you establish against sudden shocks. Liquidity is an important consideration in building protection. Holding a portion of your portfolio in highly liquid assets allows you to respond to market changes without being forced into unfavorable sales. Access to cash or liquid securities provides flexibility and reduces the pressure to make reactive decisions in times of volatility. Maintaining liquidity ensures that you can manage emergencies, seize strategic opportunities, and protect long-term growth without compromising the foundation of your portfolio. Regular risk assessment strengthens safety margins. Evaluate the potential downside of each investment, considering worst-case scenarios and possible market disruptions. Understanding the maximum plausible loss allows you to structure your portfolio to absorb shocks without jeopardizing overall objectives. Risk assessment is not a one-time exercise. It should be continuous, adapting to market developments, changes in the economy, and shifts in individual investment characteristics. Applying conservative allocation principles reinforces protection. Avoid concentrating too much capital in high-risk assets, speculative ventures, or volatile markets. Assign portions of your portfolio to stable, well-understood investments that provide consistent returns. This balanced allocation reduces the likelihood of catastrophic losses and ensures that sudden market shifts do not undermine long-term plans. Conservative structuring is a proactive step towards safeguarding wealth. Insurance strategies can supplement financial safety margins. Certain investment vehicles or instruments, such as options, stop-loss orders, or hedging strategies, provide explicit protection against declines. These tools should be used judiciously and as part of a comprehensive plan to manage risk. Leveraging insurance mechanisms appropriately appropriates resilience without overcomplicating the portfolio or creating excessive dependency. Margin of safety also applies to spending and personal finances. Avoid over-leveraging, excessive debt, or commitments that limit flexibility. By maintaining financial discipline, you ensure that resources are available to navigate downturns without compromising essential goals. The principle extends beyond individual investments to overall financial management, reinforcing stability and preparedness. Consistent review and adjustment are essential. Market conditions, asset performance, and personal circumstances change over time. Periodically reassessing your portfolio ensures that safety margins remain sufficient and aligned with current realities. Adjustments may include rebalancing, reducing exposure to high-risk assets, or increasing reserves to maintain adequate protection. Vigilance keeps the margin effective and responsive to evolving challenges. Patience complements safety margins. Avoid making impulsive moves based on short-term market events. Safety margins allow you to withstand volatility, giving your investments time to recover or realize their potential. Long-term perspective combined with structural protection ensures that temporary losses do not derail overall progress. Patience turns volatility into manageable fluctuations rather than threats. Education and understanding of the instruments you hold are key to effective protection. Knowing the risks, historical behavior, and market dynamics of your investments allows you to structure margins intelligently. Deep knowledge enables precise allocation, reduces overexposure, and enhances confidence in your decisions. An informed approach ensures that safety margins are grounded in rational analysis rather than arbitrary caution. Behavioral discipline is reinforced by safety margins. When investors are confident that their portfolios have built-in protection, emotional reactions, such as panic selling or overreacting to market news, diminish. Reduced emotional pressure enhances decision-making, encourages strategic thinking, and strengthens resilience. Discipline and protection are mutually reinforcing, creating a framework for consistent, rational action. Avoid excessive complexity in creating safety margins. Overly complicated structures, excessive hedging, or unnecessary instruments can create confusion and reduce effectiveness. Simplicity ensures that protection is clear, manageable, and practical. The goal is to create a margin that works reliably under various scenarios, not to over-engineer solutions that increase risk of error. Safety margins also provide opportunities for strategic action. When markets decline, having protection allows you to acquire assets at favorable prices without jeopardizing stability. The buffer created by conservative planning and risk management becomes a tool for growth, enabling intelligent action when opportunities arise rather than reactive scrambling. Protection and opportunity go hand in hand. Reflecting on historical market behavior reinforces the importance of safety margins. Every financial downturn, crash, or correction highlights the consequences of overexposure and inadequate preparation. Learning from past events allows you to structure investments prudently, anticipating potential shocks and building resilience. Historical insight transforms abstract caution into actionable principles that safeguard your resources. The communication and transparency with partners, family, or co-investors strengthen protection strategies, ensuring all parties understand the rationale for safety margins, and risk management reduces pressure to take impulsive actions. Alignment of expectations supports disciplined decision-making and reinforces adherence to protective measures. Clear understanding across stakeholders prevents unnecessary compromises in the pursuit of short-term gains. Reinforcing safety margins with contingency planning is essential. Identify scenarios that could impact your investments and define specific responses. Contingency measures, such as emergency reserves, flexible asset allocation, or predefined exit strategies, provide structure and reduce uncertainty. Planning for the unexpected transforms risk into manageable, controllable elements rather than leaving outcomes to chance. Incremental application of safety margins is effective. Gradually increasing the buffer as capital grows or as exposure to risk rises ensures protection scales with potential impact. Incremental reinforcement prevents overconfidence, builds habit, and keeps portfolios aligned with evolving objectives. Safety becomes a proactive practice rather than an afterthought. Ultimately, creating safety margins is not merely about avoiding losses, but about enabling confident, rational investing under uncertainty. It combines knowledge, discipline, planning, and foresight to preserve capital, manage risk, and maintain long-term progress. By incorporating margins of safety, investors strengthen resilience, enhance decision-making, and ensure that temporary setbacks do not compromise broader goals. Protection transforms volatility into opportunity, stability into freedom, and prudence into sustainable growth. Chapter 14. Diversify investments to reduce risk and ensure stability. Diversifying investments is one of the most effective strategies to manage risk and create long-term financial stability. No single asset or market can provide guaranteed returns, and concentration in one area exposes investors to unpredictable shocks. By spreading capital across multiple investments, sectors, and asset classes, you reduce the impact of poor performance in any single area. Diversification does not eliminate risk entirely, but it transforms it from a potential catastrophe into a manageable and strategic challenge. This approach allows for steadier growth and enhances resilience against market volatility. Begin by analyzing your current portfolio and identifying areas of concentration. Understanding where your exposure lies is the first step toward balance. Overweighting one sector, stock, or asset class increases vulnerability to downturns, whereas underrepresentation in other areas may cause missed opportunities. Evaluating the portfolio comprehensively provides insight into how to allocate resources more effectively for protection and growth. Invest across different asset classes, such as equities, bonds, real estate, and commodities. Each asset type behaves differently under varying economic conditions. Stocks might provide growth potential during economic expansion, while bonds offer stability during periods of market decline. Real estate can generate income and long-term appreciation, and commodities often move independently of traditional markets. Allocating across these classes smooths performance and reduces overall risk. Geographic diversification further strengthens stability. Investing in different countries or regions reduces reliance on the economic performance of a single nation. Political instability, currency fluctuations, or regulatory regime can impact localized investments, but spreading across diverse markets mitigates these risks. Global diversification ensures that your portfolio is not overly dependent on the fortunes of one economy or policy environment. Industry and sector diversification is equally important. Different sectors respond uniquely to economic cycles, technological developments, and consumer trends. Allocating investments across multiple industries, such as technology, healthcare, finance, and energy, provides a buffer against downturns in any single field. When one sector underperforms, others may perform strongly, maintaining overall portfolio balance. Avoid over-diversification, which can dilute returns and create unnecessary complexity. While spreading investments is valuable, excessive fragmentation may make it difficult to manage, monitor, and optimize. The goal is strategic diversification, where each allocation is intentional and contributes meaningfully to risk reduction and growth potential. Focus on quality over quantity while maintaining balance. Regular portfolio rebalancing ensures that diversification remains effective over time. Market movements can shift the relative weight of different investments, leading to unintentional concentration. Rebalancing involves adjusting holdings to maintain your target allocation and risk profile. This process restores discipline, reinforces strategy, and prevents drift that could compromise stability. Correlation analysis enhances diversification effectiveness. Understanding how different investments respond to market conditions allows you to combine assets that move independently or inversely. Low or negative correlation between assets increases protection because losses in one area may be offset by gains in another. Analyzing correlations improves the quality of diversification and strengthens overall portfolio resilience. Include a mix of growth and defensive investments. Growth investments, such as equities or emerging markets, provide potential for significant appreciation, but can be volatile. Defensive investments, like bonds or dividend-paying stocks, offer stability and income during uncertain periods. Combining these approaches balances risk and reward, creating a more resilient and adaptable portfolio. Consider alternative investments for additional diversification. Assets like private equity, hedge funds, or precious metals often behave differently from traditional markets. While not suitable for all investors, incorporating alternative strategically can enhance stability and reduce dependency on standard market movements. Diversification through alternative assets should be applied carefully, with attention to risk, liquidity, and expertise. Regular monitoring of investment performance ensures that diversification continues to serve its purpose. Assess each holding periodically to ensure alignment with goals, risk tolerance, and market conditions. Monitoring allows proactive adjustments, prevents overexposure, and confirms that each investment contributes effectively to overall stability. Vigilance strengthens the benefits of diversification over time. Understand the role of time in diversification. Long-term investments benefit more from diversified allocations because short-term fluctuations are smoothed by broader exposure. Patience and consistency amplify the protective effects of diversification, allowing compounding and growth to work while minimizing the impact of individual market swings. Time enhances the stability achieved through careful allocation. Focus on value within each diversified component. Diversification is not just about spreading investments, but also ensuring that each allocation is sound, based on fundamentals, and aligns with long-term objectives. Quality assets reduce the risk of losses and strengthen the overall portfolio. Disciplined selection complements diversification by combining risk management with growth potential. Avoid following trends blindly when diversifying. Popular sectors, hot stocks, or speculative markets may seem appealing, but diversification should be driven by strategy, analysis, and risk management rather than hype. Strategic allocation ensures that exposure is purposeful and consistent with objectives, reducing vulnerability to emotional or impulsive decisions. Liquidity considerations enhance the effectiveness of diversification. Ensure that a portion of the portfolio remains accessible to address unexpected needs or opportunities. Highly illiquid assets may offer potential returns, but can create constraints during market stress. Balanced allocation between liquid and less liquid investments supports flexibility and resilience. Diversification also protects against behavioral biases. Investors often make decisions based on emotion, anecdotal evidence, or peer influence. A structured and diversified approach reduces the impact of these biases by providing a disciplined framework that guides allocation and decision-making. Strategic diversity encourages rational action and consistency. Tax efficiency should be considered when diversifying. Different investments have varying tax implications that can affect net returns. Structuring diversification with attention to taxation enhances overall efficiency, preserves wealth, and supports long-term growth. Awareness of tax effects ensures that diversification contributes to both stability and net performance. Strategically combining active and passive investments enhances diversification benefits. Passive investments, such as index funds, provide broad market exposure and reduce individual selection risk. Active investments allow targeted opportunities and specialized strategies within areas of expertise. A mix of both approaches balances stability with potential for outperformance while maintaining overall portfolio diversity. Documenting your diversification strategy supports consistency. Clearly outlining asset allocation, sector exposure, geographic distribution, and rationale ensures that each investment serves a purpose. Documentation reinforces discipline, provides a reference for future decisions, and ensures that diversification remains intentional rather than accidental. Ultimately, diversification reduces risk, smooths returns, and strengthens stability in an uncertain financial environment. It provides a structured framework for balancing growth and protection, enabling disciplined, strategic, and informed decision-making. By spreading investments across asset classes, sectors, regions, and strategies, you create resilience that allows you to navigate volatility confidently, seize opportunities thoughtfully, and maintain a path toward long-term financial security and success. Chapter 15. Strengthen confidence by following a clear financial plan. Confidence in investing is built on clarity, preparation, and consistent execution, and following a clear financial plan is the most reliable way to achieve it. Uncertainty and doubt often arise when decisions are made impulsively or without a structured approach, creating anxiety and undermining performance. A well-defined financial plan acts as a roadmap that guides actions, reinforces discipline, and instills certainty. It provides a framework for making informed choices, managing risk, and pursuing long-term objectives with clarity and purpose. Start by setting specific, realistic, and measurable financial goals. Goals create direction and purpose, helping you focus on what matters most. Whether your aim is wealth accumulation, retirement security, or funding personal milestones, defining clear targets provides a foundation for strategic planning. Concrete goals transform abstract ambitions into actionable steps and give confidence in the path you follow. Assess your current financial situation honestly and thoroughly. Evaluate income, expenses, assets, liabilities, and cash flow. Understanding your starting point allows for accurate planning and ensures that strategies are grounded in reality. Awareness of strengths and weaknesses builds confidence because decisions are based on fact rather than assumption, and it highlights areas where adjustments can enhance stability and growth. Design a plan that aligns with your risk tolerance. Confidence grows when you know that your strategy suits your comfort level and ability to withstand market fluctuations. Overly aggressive or speculative approaches may create stress, while a tailored plan promotes calm, rational decision-making. Matching strategy with temperament ensures that you remain committed even during challenging periods. Incorporate budgeting and disciplined spending into your plan. Effective financial management begins with control over cash flow, prioritizing essential expenses, and directing surplus toward investments. Clear allocation and consistent discipline reduce uncertainty, minimize waste, and support progress toward goals. A structured approach to budgeting reinforces confidence by demonstrating control over resources and the ability to execute the plan consistently. Develop an investment strategy that is consistent and evidence-based. Define asset allocation, diversification, and criteria for selection and exit. Clarity in strategy ensures that every action is intentional rather than reactive. When rules are established in advance, you can make decisions with confidence, knowing that each step aligns with a thoughtful plan rather than external pressures or emotion. Anticipate potential risks and incorporate protective measures, safety margins, diversification, and contingency planning reduce vulnerability to unforeseen events. Knowing that your plan has built-in buffers allows you to act with composure during volatility. Confidence is strengthened when you understand potential challenges and have defined methods to manage them effectively. Regular monitoring and review are essential to maintaining confidence. Tracking performance, progress toward goals, and alignment with your strategy ensures that you remain informed and proactive. Adjustments should be data-driven and deliberate, rather than reactive. Continuous oversight reinforces control and reduces anxiety because you know where you stand at all times. Education and knowledge reinforce a sense of control and certainty. Understanding market dynamics, investment principles, and financial instruments allows you to make informed decisions. Knowledge transforms uncertainty into actionable insight, reducing hesitation and building self-assurance. Continuous learning ensures that your confidence is grounded in competence rather than wishful thinking. Maintain a long-term perspective. Short-term market fluctuations, economic changes, or unexpected setbacks can create doubt if your focus is limited to immediate outcomes. Confidence grows when you prioritize long-term objectives and understand that temporary disruptions are part of the process. Patience combined with a clear plan allows consistent, rational decision-making despite external noise. Implement measurable milestones to track progress. Breaking goals into smaller steps provides tangible indicators of achievement, reinforcing confidence through visible results. Each milestone achieved demonstrates the effectiveness of your plan and motivates continued adherence. Structured progression builds trust in your strategy and strengthens the habit of disciplined execution. Avoid comparing yourself to others. External influences can create insecurity and pressure to deviate from your plan. Confidence is rooted in alignment with your own objectives and strategy, rather than reacting to others' actions. Staying focused on personal targets allows rational decision-making and reinforces belief in your approach. Document your plan and rationale for each decision. Writing down strategies, assumptions, and expected outcomes clarifies thought processes and provides a reference for evaluation. Documentation ensures consistency, accountability, and clarity, allowing you to act decisively and avoid confusion when challenges arise. A clear record of your reasoning strengthens both confidence and discipline. Incorporate flexibility within your plan. While consistency is critical, adjustments may be necessary due to changes in personal circumstances or market conditions. Flexibility within a structured framework allows responsive action without undermining the integrity of your strategy. Confidence is enhanced when you know that adjustments are intentional, controlled, and aligned with long-term objectives. Use past successes and lessons learned to reinforce belief in your plan. Reflecting on previous accomplishments and well-executed decisions provides evidence of capability. Awareness of effective past behavior builds trust in your judgment and fosters a positive mindset toward ongoing investment decisions. Learning from experience converts challenges into confidence-building opportunities. Create accountability measures. Sharing your plan with a mentor, advisor, or trusted partner reinforces commitment and discipline. Accountability ensures that adherence to your strategy remains consistent and that decisions are carefully considered. External reinforcement complements internal confidence, providing additional assurance that your plan is effective. Practice disciplined execution. Confidence grows when actions consistently reflect thoughtful planning rather than impulse. Following a clear plan fosters reliability, reduces stress, and develops habits that support long-term success. Discipline and confidence reinforce each other, creating a cycle of positive, intentional behavior. Emphasize simplicity and clarity in all aspects of your financial plan. Complexity can undermine confidence by creating confusion or excessive monitoring requirements. A clear, understandable plan allows you to make decisions quickly, evaluate options effectively, and maintain focus on priorities. Simplicity enhances control, reduces mistakes, and strengthens belief in your strategy. Prepare for contingencies and unexpected events. Building emergency reserves, defining thresholds for action, and anticipating challenges ensures that you can maintain composure and continue executing your plan even under pressure. Confidence is grounded in the knowledge that you have considered potential obstacles and are prepared to manage them effectively. Ultimately, confidence in investing arises from preparation, clarity, and disciplined execution. A clear financial plan provides structure, reduces uncertainty, and reinforces rational decision-making. By defining goals, aligning strategy with risk tolerance, incorporating protective measures, and consistently monitoring progress, you cultivate self-assurance that allows intelligent, deliberate action. Confidence enables persistence, focus, and resilience, ensuring that financial decisions support long-term growth and stability, while empowering you to navigate challenges with clarity and control. Chapter 16. Commit to lifelong learning about markets and opportunities. Committing to lifelong learning about markets and opportunities is essential for sustained financial growth and personal development. The financial world is constantly evolving, influenced by economic shifts, technological innovation, geopolitical changes, and consumer behavior. Staying informed and continually expanding your knowledge equips you to navigate these dynamics effectively. Learning is not a one-time task, but a continuous process that shapes decision-making, strengthens strategy, and builds confidence in handling uncertainty. By dedicating yourself to ongoing education, you ensure that your decisions remain informed, deliberate, and aligned with long-term objectives. Start by establishing a daily habit of learning. Allocate time to read financial news, analyze reports, and study market trends. Even brief, consistent engagement accumulates into significant insight over time. Familiarity with current events and economic shifts provides context for investments and helps identify emerging opportunities. Regular exposure to relevant information reinforces understanding and strengthens analytical skills. Develop a structured approach to education. Identify key areas such as stock valuation, macroeconomic principles, portfolio management, and risk assessment. Organize learning into manageable segments to ensure depth and clarity. Structured study prevents superficial understanding and allows you to develop expertise in areas that directly impact your investment strategy. A focused, organized approach accelerates mastery and builds competence. Learn from multiple sources. Books, audiobooks, seminars, webinars, podcasts, and reputable online platforms offer diverse perspectives. Exposure to different viewpoints broadens understanding, challenges assumptions, and encourages critical thinking. Multiple perspectives help identify biases, reveal overlooked opportunities, and improve decision-making quality. Lifelong learning thrives on variety and depth, creating a well-rounded foundation for action. Observe and study experienced investors. Analyzing their strategies, decisions, and outcomes provides practical insight that complements theoretical knowledge. Learn how successful investors assess opportunities, manage risks, and respond to challenges. Emulating proven principles and adapting them to your context strengthens judgment, reinforces discipline, and accelerates growth. Lessons from experience often provide clarity that textbooks alone cannot offer. Develop analytical skills alongside knowledge acquisition. Understanding financial statements, market indicators, and economic trends is critical for interpreting information effectively. Analytical skills enable you to assess opportunities objectively, distinguish between noise and meaningful signals, and make informed decisions. The ability to process and evaluate information critically transforms learning into actionable intelligence. Engage in reflective learning. Regularly evaluate past decisions, successes, and mistakes. Analyzing outcomes deepens understanding, reveals patterns, and identifies areas for improvement. Reflection ensures that knowledge is internalized, lessons are retained, and future choices benefit from experience. Lifelong learning is not just accumulation of information, it is integration and application. Participate in communities of like-minded learners. Networking with other investors, attending discussion groups, and joining online forums facilitates exchange of ideas, challenges assumptions, and exposes you to new strategies. Learning collaboratively enhances perspective, fosters accountability, and accelerates growth. Interaction with peers creates an environment where continuous improvement is reinforced through dialogue and shared experience. Adapt learning to evolving markets. Strategies that worked in one environment may require adjustment in another. Staying informed about technological developments, policy changes, and shifting consumer behavior ensures that your knowledge remains relevant. Lifelong learning is dynamic, requiring flexibility and openness to change. Continuous adaptation prevents stagnation and positions you to seize emerging opportunities. Balance theoretical knowledge with practical experience. Applying concepts in real-world scenarios solidifies understanding and tests ideas under real conditions. Learning through practice builds intuition, enhances problem-solving, and reveals nuances that theoretical study may overlook. Experience-driven learning bridges the gap between knowledge and execution, strengthening confidence and competence. Stay curious and ask questions consistently. Questioning assumptions, seeking clarification, and exploring new topics deepen insight and enhance retention. Curiosity drives exploration, encourages creativity, and prevents complacency. Lifelong learners cultivate a mindset that views challenges as opportunities for discovery and growth, rather than obstacles. Use technology as a learning tool. Financial platforms, simulation tools, and analytical software provide practical ways to test hypotheses, track trends, and monitor outcomes. Leveraging technology accelerates understanding, enhances precision, and supports informed decision-making. Integration of digital tools transforms learning into an interactive and measurable process. Establish measurable goals for your learning journey. Define specific knowledge areas to master, skills to acquire, or milestones to achieve within a set time frame. Tracking progress provides motivation, reinforces commitment, and ensures consistent advancement. Goal-oriented learning converts abstract intentions into actionable steps and tangible outcomes. Priorities depth over breadth. While exposure to many topics is valuable, deep comprehension in core areas relevant to your investments ensures competence and confidence. Focused mastery enables you to make decisions with authority, anticipate market behavior, and avoid superficial judgment. Depth strengthens credibility and reinforces strategic thinking. Maintain discipline in your learning routine. Consistent engagement, even during busy periods or when immediate results are not visible, accumulates over time. Discipline ensures that education remains a habit, not an occasional activity. Regular, structured learning builds momentum, enhances retention, and reinforces long-term growth. Learn from setbacks and failures. Markets inevitably involve mistakes and challenges, and each presents an opportunity to gain insight. Analyze errors to understand causes, adjust approaches, and refine strategies. Viewing setbacks as lessons transforms disappointment into progress and reinforces the mindset of continuous improvement. Incorporate cross-disciplinary learning. Economics, psychology, statistics, and technology all impact investment outcomes. Understanding these adjacent fields enhances analysis, improves foresight, and provides additional tools for strategic decisions. Broader knowledge allows you to anticipate changes, interpret trends more accurately, and create innovative solutions. Document insights and lessons learned. Maintaining records of observations, analyses, and key takeaways ensures that knowledge is retained and easily referenced. Documentation reinforces memory, organizes learning, and provides a resource for future decisions. Systematic recording converts experience into a reusable and practical asset. Emphasize adaptability alongside learning. Markets change, opportunities shift, and external conditions evolve. Lifelong learning equips you to respond effectively, identify new paths, and adjust strategies proactively. Flexibility combined with continuous education ensures that knowledge remains relevant and actionable over time. Integrate learning with disciplined execution. Knowledge without action is ineffective, and action without understanding is risky. Applying new insights, testing strategies, and adjusting approaches based on learning bridges the gap between theory and results. The combination of knowledge and disciplined implementation fosters growth, confidence, and resilience. Ultimately, committing to lifelong learning creates a foundation for informed, deliberate, and adaptive investing. Continuous education strengthens judgment, enhances decision-making, and cultivates the ability to identify opportunities before others. By consistently expanding knowledge, analyzing experience, and applying insights, you develop resilience, confidence, and strategic foresight that support sustainable financial growth and long-term success. Chapter 17. Build resilience by preparing for inevitable financial downturns. Building resilience by preparing for inevitable financial downturns is one of the most crucial strategies for long-term success in investing and personal finance. Economic cycles are unavoidable, and every market experiences periods of volatility, contraction, and uncertainty. Preparing in advance does not mean predicting the future perfectly, but creating systems and habits that allow you to weather challenges without panic or reckless decisions. Resilience is cultivated through discipline, foresight, and deliberate planning, providing the confidence and stability needed to navigate difficult periods effectively. Start by analyzing potential risks in your portfolio and personal finances. Understanding what could go wrong and the potential magnitude of losses provides a realistic foundation for preparation. Consider market downturns, sector-specific declines, changes in interest rates, inflation, and unexpected personal expenses. Assessing these factors enables you to develop strategies that reduce vulnerability and strengthen capacity to absorb shocks. Knowledge of potential threats transforms uncertainty into manageable, actionable steps. Create emergency reserves to serve as a buffer during financial stress. A cash reserve, or liquid assets equivalent to several months of expenses, allows you to meet obligations without needing to sell investments at unfavorable times. Having accessible funds reduces pressure, prevents hasty decisions, and maintains long-term strategies intact. Liquidity in preparation fosters peace of mind and reinforces discipline when markets fluctuate. Diversification is a fundamental tool for resilience. Spreading investments across asset classes, sectors, and geographic regions reduces reliance on any single market or economic factor. Diversification does not eliminate risk entirely, but transforms potential catastrophic losses into manageable fluctuations. A well-balanced portfolio is less vulnerable to sudden shocks and provides stability, making it easier to maintain strategy during downturns. Maintain a margin of safety in all investment decisions. Acquiring assets at prices below intrinsic value provides a cushion against temporary declines. Safety margins create room for error, and market volatility while preserving capital. They prevent panic selling and allow investors to maintain long-term strategies even when markets are turbulent. This principle applies equally to personal budgets, debt management, and financial commitments, reinforcing overall resilience. Implement risk management strategies to anticipate potential challenges. Assessing downside scenarios, stress testing investments, and preparing contingency plans ensures that you can respond rationally when difficulties arise. A proactive approach mitigates the impact of adverse events and strengthens confidence in your ability to manage uncertainty effectively. Risk management is a deliberate practice that converts potential threats into controllable factors. Adopt a long-term perspective in the face of downturns. Short-term declines are often inevitable, but maintaining focus on long-term goals prevents reactive decisions that could harm future growth. Viewing downturns as temporary phases rather than permanent failures allows disciplined investors to act calmly and strategically. Resilience is reinforced when patience and perspective are applied consistently. Monitor cash flow and spending closely. Controlling expenses, prioritizing essentials, and avoiding unnecessary financial commitments creates flexibility during challenging times. Careful cash management ensures that obligations are met without compromising investments or long-term plans. Financial discipline strengthens resilience by reducing exposure to external pressures and maintaining stability even during disruptions. Education and preparedness are essential components of resilience. Understanding market dynamics, economic cycles, and historical patterns equips you to anticipate downturns and respond effectively. Knowledge reduces fear, supports rational decision-making, and fosters confidence in navigating uncertainty. Continuous learning ensures that strategies remain relevant and adaptive as conditions evolve. Establish rules for disciplined decision-making. Define criteria for buying, selling, or adjusting investments during market stress. Predefined rules prevent emotional reactions, impulsive trading, and decisions driven by fear or greed. Structured processes create consistency and reduce the psychological impact of sudden market declines, reinforcing resilience through rational action. Leverage diversification between growth and defensive assets. Growth investments provide potential appreciation, while defensive assets such as bonds, dividend stocks, or stable real estate offer protection during volatility. Balancing these allocations reduces exposure to sharp declines and creates stability across market cycles. Resilience emerges from the ability to withstand temporary setbacks without compromising strategic objectives. Prepare mentally and emotionally for downturns. Financial stress often triggers fear, doubt, and impulsive behavior. Strengthening emotional discipline through reflection, mindfulness, or structured decision-making supports clarity during uncertainty. Mental preparedness ensures that reactions remain rational, allowing you to implement protective measures calmly and effectively. Review and adjust debt management strategies. Minimizing high-interest or non-essential debt enhances flexibility during financial stress. Reducing obligations lowers pressure during downturns and prevents financial strain from amplifying market-related losses. A disciplined approach to debt creates freedom to focus on strategic priorities rather than crisis management. Maintain a proactive communication plan with stakeholders. Family members, partners, or co-investors should understand potential risks and planned responses. Shared understanding reduces conflict, aligns expectations, and reinforces adherence to predefined strategies. Transparency in planning strengthens confidence and provides social reinforcement during challenging periods. Simulate downturn scenarios to test resilience. Modeling potential financial shocks, changes in income, or market declines, provides insight into vulnerabilities and helps refine protective measures. Scenario planning ensures that strategies are robust, realistic, and effective under a variety of conditions. Anticipating outcomes transforms uncertainty into actionable preparation. Focus on incremental, sustainable adjustments rather than drastic reactions. Small, deliberate actions preserve stability while addressing emerging challenges. Gradual adaptation reinforces confidence, maintains alignment with long-term goals, and prevents overreaction that could exacerbate setbacks. Resilience is cultivated through thoughtful, measured responses rather than impulsive measures. Track performance and maintain perspective during downturns. Regular monitoring allows for informed decisions and confirms that portfolio adjustments align with objectives. Observing progress relative to long-term goals reinforces the notion that short-term volatility does not derail overall plans. Perspective enhances confidence and prevents panic-based decisions. Leverage professional advice when needed. Financial advisors, mentors, or industry experts can provide guidance, perspective, and strategic input during periods of uncertainty. Expert insight enhances preparedness, identifies overlooked risks, and reinforces structured responses. Collaboration strengthens resilience by combining personal understanding with experienced judgment. Reinforce resilience through habits of discipline and consistency. Regular investment, monitoring, and strategic review create a foundation that withstands shocks. Habits developed in stable periods carry over into turbulent times, reducing vulnerability and enabling measured responses. Discipline transforms routine actions into protective mechanisms that endure across cycles. Ultimately, building resilience is about preparing for uncertainty with foresight, discipline, and practical strategies. By anticipating risks, maintaining liquidity, diversifying wisely, and cultivating mental and emotional readiness, you create the capacity to endure financial downturns without compromising long-term objectives. Resilience allows you to act strategically, protect assets, and capitalize on opportunities that arise during volatility. Preparation transforms potential threats into manageable challenges and ensures sustained progress even in difficult conditions. Chapter 18. Apply patience and consistency to achieve long-term success. Patience and consistency are fundamental principles for achieving long-term success in investing and personal finance. Many people seek quick wins or immediate gratification, but true wealth and stability are built over time through deliberate, disciplined action. Applying patience means resisting the urge to react impulsively to market fluctuations, temporary setbacks, or external noise. Consistency ensures that daily decisions align with strategic goals, creating cumulative progress that compounds over months and years. Together, these qualities form the backbone of sustainable financial growth and personal development. Begin by establishing clear long-term objectives. Success is difficult to achieve without a defined destination. Goals provide direction, purpose, and motivation to maintain consistent effort over extended periods. They serve as reference points during times of uncertainty, reminding you why patience is necessary and reinforcing commitment to steady progress. Clear objectives create a framework within which consistency becomes meaningful rather than mechanical. Develop disciplined routines that reinforce consistency. Allocate time for monitoring investments, reviewing budgets, and learning about markets. Daily habits, even small ones, accumulate into substantial results over time. Routine actions reduce reliance on emotion, ensure adherence to strategy, and cultivate a mindset that values steady advancement over rapid, unstable gains. Consistency in practice is the engine that converts plans into tangible outcomes. Practice delayed gratification in decision-making. Avoid impulsive trades, speculative investments, or unnecessary expenditures that may provide short-term pleasure but undermine long-term objectives. Delayed gratification strengthens control, reinforces patience, and protects capital from hasty mistakes. Understanding that meaningful results require time helps maintain focus on the bigger picture and prevents distraction by temporary trends. Monitor progress systematically while avoiding overreaction. Regular evaluation of portfolios and financial goals ensures alignment with plans, but must be approached rationally. Short-term volatility is part of every market cycle, and excessive focus on immediate fluctuations can lead to counterproductive decisions. Patience allows for observation and learning, while consistency ensures that corrective measures are deliberate and proportional. Establish a disciplined investment strategy and adhere to it over time. Define criteria for asset selection, risk tolerance, and diversification. Once these parameters are in place, allow them to guide decisions consistently. Frequent changes based on short-term noise erode progress and increase exposure to errors. Following a consistent strategy builds confidence, reinforces habits, and maximizes the benefits of long-term planning. Understand the power of compounding. Small, consistent contributions to savings or investments grow exponentially over time. Compounding rewards patience and disciplined action more than sporadic, high-risk efforts. Recognizing this principle encourages a long-term mindset and strengthens commitment to steady, incremental progress. The impact of patience and consistency becomes tangible as growth accumulates steadily, demonstrating the value of sustained effort. Develop resilience to setbacks and delays. Financial markets and life circumstances are unpredictable, and challenges are inevitable. Patience allows for calm response, while consistency ensures that efforts continue despite temporary setbacks. Resilience reinforces the ability to persist, learn from mistakes, and adjust strategies without abandoning core objectives. Endurance during difficult periods is a hallmark of successful investors and individuals. Align daily actions with long-term priorities. Every choice, from spending to investing, contributes incrementally to broader goals. Consistently aligning behavior with priorities creates habits that naturally reinforce objectives over time. Patience ensures that the impact of each action is evaluated in context, while consistency transforms repeated actions into measurable progress. Incremental alignment creates a trajectory toward lasting success. Avoid comparison with others to maintain focus. Short-term performance of peers, market hype, or external pressure can provoke impatience or erratic behavior. Staying committed to your own strategy reinforces consistency and reduces the temptation to chase fleeting trends. Personal discipline, guided by patience, ensures that decisions remain aligned with long-term goals rather than external noise. Emphasize learning and adaptation alongside persistence. Consistency does not imply rigidity. Patience allows careful assessment of outcomes, and insights gained from experience inform small, deliberate adjustments. Continuous improvement, when combined with steady action, ensures that strategies evolve intelligently while maintaining long-term direction. Adaptation within a consistent framework strengthens results without undermining discipline. Track milestones to visualize progress. Short-term indicators of improvement reinforce patience and demonstrate the cumulative impact of consistent effort. Tangible markers of success, even incremental, provide motivation, validate strategies, and highlight areas that require refinement. Monitoring progress encourages adherence to disciplined routines while reinforcing confidence in long-term outcomes. Maintain emotional discipline during periods of market or personal volatility. Impulsive reactions can derail steady progress, whereas patience enables measured responses that align with strategic objectives. Emotional stability ensures that consistent actions remain purposeful, rational, and effective even under stress. Developing control over impulses is essential to preserving long-term gains and sustaining momentum. Practice goal-oriented prioritization to focus effort effectively. Time, energy, and resources are limited, and applying them consistently toward high-impact objectives maximizes results. Patience ensures that progress is not rushed or misdirected, while consistency ensures that effort compounds effectively over time. Prioritization strengthens discipline, reduces wasted energy, and accelerates meaningful advancement. Cultivate habits that reinforce both patience and consistency. Daily practices such as disciplined investing, regular learning, and thoughtful decision-making build momentum over time. Habits reduce reliance on willpower, embed strategic thinking into routine behavior, and create predictable pathways toward long-term success. Repetition transforms effort into skill, and skill compounds into results. Anticipate challenges and plan contingencies in advance. Preparing for unexpected events allows for measured responses without compromising long-term objectives. Patience enables calm assessment, while consistent adherence to contingency plans maintains stability during disruptions. Anticipation and preparation ensure that temporary obstacles do not derail sustained progress. Focus on incremental improvement rather than immediate perfection. Small, steady gains accumulate more reliably than sporadic attempts at rapid advancement. Consistency in refining skills, strategies, and decision-making produces compounding benefits. Patience prevents frustration from temporary setbacks and reinforces a long-term perspective that values enduring progress over instant results. Balance risk with prudence in every decision. Consistent application of a well-considered risk framework reduces exposure to unnecessary setbacks. Patience allows observation of trends and evaluation of outcomes before committing additional resources. Combined, these qualities ensure steady advancement while minimizing disruptions caused by impulsive or poorly assessed actions. Maintain perspective on the broader journey. Long-term success is achieved through a series of deliberate, consistent choices accumulated over time. Temporary fluctuations, delays, or mistakes are part of the process and do not negate progress. Patience and consistency enable a focus on the ultimate destination, providing clarity, motivation, and resilience throughout the journey. Ultimately, applying patience and consistency creates a foundation for lasting achievement in investing and personal development. These qualities transform daily actions into cumulative results, strengthen decision-making, and cultivate resilience in the face of volatility. By committing to steady, deliberate effort, maintaining discipline, and focusing on long-term objectives, you develop the capacity to achieve meaningful, sustainable success that endures well beyond short-term challenges. Chapter 19. Make decisions based on facts, not short-term noise. Making decisions based on facts, rather than short-term noise, is essential for achieving lasting success in investing and personal finance. The world is full of distractions, rumors, and sensational headlines that can provoke emotional reactions and lead to poor choices. Markets fluctuate daily, and minor events often receive disproportionate attention. Reacting to these temporary signals without grounding decisions in verified information undermines long-term objectives. A disciplined approach requires gathering accurate data, analyzing trends logically, and ensuring every action aligns with objective reasoning rather than impulsive sentiment. Start by identifying reliable sources of information. Financial statements, regulatory filings, reputable news outlets, and verified economic data provide an accurate picture of underlying conditions. Avoid relying on social media chatter, unverified tips, or hype-driven commentary that often distorts reality. Establishing a foundation of trustworthy information ensures decisions are based on measurable facts rather than speculation or rumor. Develop a structured analytical process to evaluate data. Assess both qualitative and quantitative aspects, including financial performance, market position, and broader economic factors. Objective analysis reduces susceptibility to emotion-driven decisions and reinforces strategic thinking. When a consistent framework is applied to each decision, choices become deliberate, defensible, and aligned with long-term goals. Separate emotions from decision-making. Excitement, fear, and impatience are natural reactions to market movements, but often lead to impulsive behavior. Recognizing emotional triggers allows for controlled responses and prevents short-term noise from overriding rational judgment. Emotional discipline enables you to act in accordance with verified data rather than reacting to transient conditions. Focus on long-term trends rather than immediate fluctuations. Markets naturally experience ups and downs, and short-term movements rarely reflect the true value of an investment. By concentrating on fundamental metrics, growth potential, and risk-adjusted returns, decisions remain grounded in reality. Long-term orientation reduces the impact of temporary disturbances and enhances the probability of sustainable success. Implement predefined criteria for decision-making. Establishing thresholds, risk parameters, and performance metrics guides actions consistently and objectively. Predefined rules remove guesswork, limit impulsive reactions, and ensure that every decision has a factual basis. Discipline in adhering to these criteria strengthens confidence and reinforces rational behavior under pressure. Verify information before acting. Cross-check data from multiple sources to confirm accuracy and relevance. Misinterpretation or reliance on incomplete information can produce poor outcomes. Verification reduces uncertainty and ensures that decisions are informed, deliberate, and defensible. Fact-checking is a simple yet powerful tool for mitigating errors caused by misinformation or noise. Maintain a clear record of decisions and rationale, documenting why a choice was made based on specific data points, provides accountability and reinforces learning. Reviewing past decisions highlights patterns, validates analytical methods, and identifies areas for improvement. Record-keeping transforms experience into actionable insight and strengthens the capacity to act rationally in future situations. Avoid overreacting to market volatility. Sudden price swings, breaking news, or rumors may provoke anxiety, but long-term value is rarely determined by transient events. Assess whether changes reflect real shifts in fundamentals or temporary disturbances before making adjustments. Patience and fact-based evaluation prevent unnecessary losses and maintain strategic alignment. Use critical thinking to distinguish between relevant and irrelevant information. Not all data points are equally meaningful, and some may obscure the bigger picture. Prioritize evidence that directly impacts investment performance, risk exposure, and long-term objectives. Analytical discernment ensures that decisions focus on actionable facts rather than distractions or noise. Develop confidence in objective judgment. Repeatedly practicing fact-based analysis strengthens intuition grounded in reality rather than sentiment. Confidence derived from systematic evaluation reduces susceptibility to panic or herd behavior. A disciplined approach fosters resilience and reinforces the habit of making rational, evidence-based decisions consistently. Balance risk assessment with fact-driven evaluation. Every decision carries potential rewards and downsides, but assessing risk should be guided by measurable data rather than assumptions or short-term sentiment. Fact-based risk analysis enables informed choices, appropriate diversification, and allocation adjustments that align with long-term goals. Understanding risk through verified evidence improves resilience and reduces exposure to unnecessary setbacks. Avoid impulsive trading based on headlines or social pressure. Emotional reactions to public commentary often generate losses or missed opportunities. Following a rational, fact-oriented process ensures that trades are executed only when justified by analysis. Resisting external noise fosters discipline and enhances long-term performance. Integrate multiple perspectives without succumbing to conflicting opinions. Gathering input from experts, research, and historical trends provides context, but evaluation must remain grounded in objective criteria. Weighing diverse viewpoints critically strengthens decisions, while preventing emotional bias or overreaction to contradictory commentary. Continuously refine analytical skills. Developing the ability to interpret financial statements, market indicators, and economic data increases accuracy in distinguishing signal from noise. Skillful analysis transforms raw information into actionable insight and ensures that decisions are based on reality rather than perception. Establish a regular review routine for ongoing decisions. Frequent evaluation of portfolios, budgets, and investment strategies ensures alignment with factual data and long-term objectives. Reviews provide the opportunity to validate decisions, correct misalignments, and reinforce disciplined practices. Regular reflection strengthens understanding and reduces vulnerability to transient distractions. Practice discipline when markets are unpredictable. Volatility is inevitable, but measured action ensures that decisions remain logical and consistent with strategic goals. Discipline reinforces patience, protects against impulsive behavior, and ensures that opportunities are pursued only when supported by factual evidence. Use objective metrics to guide action. Valuation ratios, performance trends, and economic indicators offer measurable criteria for decision-making. Relying on quantifiable measures removes ambiguity, strengthens accountability, and reduces reliance on emotion or speculation. Metrics transform uncertainty into structured, actionable insight. Anticipate misinformation and cognitive biases. Confirmation bias, herd mentality, and overconfidence can distort perception of reality. Awareness of these tendencies allows for corrective measures and reinforces fact-based evaluation. Mitigating bias strengthens clarity, promotes rational decision-making, and ensures that actions remain grounded in reality. Ultimately, making decisions based on facts rather than short-term noise empowers consistent, strategic, and sustainable progress. By prioritizing verified information, applying analytical rigor, and maintaining emotional discipline, you build a framework that supports long-term success. Fact-driven decision-making reduces errors, enhances confidence, and allows you to navigate uncertainty with clarity, purpose, and resilience. The ability to separate reality from distraction is a defining characteristic of intelligent investors and individuals committed to achieving enduring results. Chapter 20. Live below your means to create lasting financial freedom. Living below your means is a fundamental principle for achieving lasting financial freedom and creating stability that endures through life's uncertainties. Many people earn significant income, yet struggle to build wealth because spending habits consistently exceed earnings. True financial independence does not depend on how much money is earned, but on the ability to control expenses, prioritize saving, and allocate resources toward long-term goals. Learning to live below your means requires discipline, awareness, and intentional decision-making, but it provides the freedom to invest, grow wealth, and reduce stress related to financial instability. Start by evaluating your current spending patterns. Track every expense for several months to understand where money is going and identify areas of unnecessary expenditure. Awareness is the first step toward control. By seeing the flow of money clearly, you can make deliberate choices that redirect funds from non-essential items to savings and investments. This practice also reveals habits that may have gone unnoticed but undermine long-term goals. Create a realistic budget that prioritizes essential needs, saving and investment contributions before discretionary spending. Allocate a fixed portion of income toward long-term growth and financial security rather than adjusting savings based on remaining funds. Treating saving as a non-negotiable obligation builds consistency, reinforces discipline, and ensures that financial progress is protected from impulsive decisions. Distinguish between wants and needs. Many purchases are driven by desire rather than necessity. Learning to differentiate these categories helps avoid wasteful spending and strengthens the ability to live within limits. Prioritize purchases that provide true value and support long-term goals, while deferring or eliminating those that satisfy short-term impulses. This mindset reduces financial stress and enhances control over resources. Adopt habits that support frugality without sacrificing quality of life. Living below your means does not require deprivation. It requires conscious decision-making and prioritization. Choose products and services that provide real value, avoid unnecessary fees, and seek efficiency in consumption. Over time, these habits create cumulative savings that significantly enhance financial resilience. Reduce high-interest debt and avoid accumulating new liabilities. Interest payments on credit cards or loans can consume large portions of income and prevent wealth accumulation. Paying off debt systematically and refraining from unnecessary borrowing strengthens financial freedom, reduces vulnerability to financial stress, and allows income to be directed toward investments rather than obligations. Automate savings and investments to reinforce discipline. Regular, automated contributions to retirement accounts, emergency funds, and investment portfolios ensure consistent progress without relying on moment-to-moment decision-making. Automation transforms financial discipline into a habitual practice, reduces temptation to overspend, and ensures that resources are consistently allocated toward long-term growth. Focus on long-term goals rather than short-term gratification. Delaying immediate pleasures in favor of future security builds patience and strengthens control over impulses. Each decision to save rather than spend is an investment in future freedom. Recognizing the value of postponed gratification reinforces sustainable financial behaviors and accelerates wealth creation over time. Implement strategic spending practices. Seek cost-effective alternatives, negotiate expenses where possible, and prioritize purchases that support personal and financial growth. Thoughtful spending maximizes the utility of every dollar, reduces waste, and ensures that resources are aligned with overarching objectives. Efficiency in spending complements saving and strengthens the foundation for lasting independence. Maintain an emergency fund to cover unexpected expenses without derailing financial plans. Preparedness reduces reliance on credit or sudden asset sales, preserving long-term strategies and protecting wealth. A well-funded reserve provides stability, reinforces the practice of living below one's means, and allows for confident decision-making during unforeseen challenges. Regularly review and adjust financial habits. Life circumstances change, and continuous evaluation ensures that spending aligns with current income goals and priorities. Periodic assessment identifies inefficiencies, strengthens discipline, and ensures that habits remain effective in supporting long-term financial freedom. Adaptation maintains relevance and enhances the sustainability of prudent practices. Avoid lifestyle inflation as income increases. Many individuals increase spending proportionally with earnings, negating potential wealth-building benefits. Maintaining a controlled lifestyle while increasing saving and investment contributions accelerates financial growth. Resisting the urge to upgrade consumption maintains stability and reinforces the principle of living below one's means. Invest the difference between earnings and expenses strategically. Money saved by controlling spending should be directed toward diversified investments that generate growth, income, and long-term security. Consistently reinvesting surplus funds amplifies the benefits of disciplined living and accelerates progress toward independence. This approach ensures that conscious restraint translates into tangible, compounding wealth. Foster a mindset of contentment and self-sufficiency. Satisfaction with what you have reduces the pressure to overspend in pursuit of social comparison or status. Contentment supports rational decision-making, enhances emotional well-being, and reinforces the discipline required to live below one's means. A strong internal perspective decreases vulnerability to external pressures and strengthens financial resilience. Set measurable goals and track progress. Define targets for savings, debt reduction, and investment accumulation, and monitor them regularly. Tracking achievements reinforces discipline, provides motivation, and demonstrates the tangible benefits of living within means. Quantifiable milestones create accountability and transform abstract concepts into concrete accomplishments. Teach and involve family members in financial discipline. Shared understanding and commitment enhance consistency, reduce conflict, and strengthen collective adherence to spending limits. Collaboration fosters an environment where prudent financial behavior is normalized and reinforced daily, enhancing the likelihood of long-term success. Leverage knowledge to optimize spending and investments. Educate yourself about personal finance, investment strategies, and efficient management of resources. Informed decision-making ensures that money is allocated effectively, risks are managed prudently, and opportunities for growth are maximized. Knowledge amplifies the benefits of living below one's means by ensuring that resources are used wisely. Resist consumerist pressures and marketing tactics. Advertisements often encourage unnecessary spending through emotional appeals or perceived scarcity. Awareness of these tactics allows for deliberate, rational choices rather than reactive purchases. Developing discernment strengthens the ability to prioritize long-term goals over transient desires. Celebrate disciplined choices to reinforce behavior. Recognizing progress, achievements, and milestones provides motivation to maintain habits. Positive reinforcement encourages continued adherence to financial principles, strengthens confidence, and transforms disciplined behavior into a sustainable lifestyle. Ultimately, living below your means creates a foundation for financial independence, stability, and long-term growth. By controlling spending, prioritizing saving, and investing surplus resources wisely, you build security that withstands economic fluctuations, reduces stress, and enhances freedom of choice. Patience, discipline, and conscious decision-making transform daily actions into cumulative wealth, demonstrating that true financial freedom is achieved not through income alone, but through consistent intentional management of resources over time.